A very good morning, everyone. Respected Chairman, Secretary, distinguished Speaker, esteemed members, and dear professional colleague. On behalf of South India Regional Council of ICI, I extend a warm welcome to all of you to this one-day CP seminar on Companies Act. As professionals, we operate in an environment where regulation evolves rapidly and expectations from stakeholders continues to increase. I am confident that today's program will be enriching learning experience for all of us. May I now request everyone to raise for ICA motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता
Now I would request CA Satish Kumar sir on the dais, please. Sir, moment of interaction. It's my privilege to introduce our distinguished speaker, CA PV Satish Kumar, partner of Ms. P. Subbarayadu and co-chartered accountants Vijayawada, the multi-qualified professional chartered accountant, cost accountant and a company secretary and an MBA. He has consistently excelled, secured an All India rank in CSCPT and serving as students vice chairman of SICASA Vijayawada. He has delivered lectures on corporate law, income tax, GST and emerging topics across India, addressing diverse audience including ICA branches, Education Institute and even 5,800 AP Police Constable on fraud awareness. Currently, he serves as co-opted member of Corporate Law Committee of SIRC of ICI 2627, a treasury of Rotary Club of Vijayawada Midtown, the largest Rotary Club in the world. Beyond his professional practice, he is a regular contributor to tax journals and ICA publication and has completed advanced certificate course in forensics and artificial intelligence. May I request everyone please join me in welcoming sir, a true example of excellence, dedication and service to the profession. Thank you. May I kindly request CA Rajesh Atulli sir to kindly present the memento as token of appreciation. So I hope everyone is excited for today's session. Without wasting time, I would please call Satish sir to take over the session. Thank you.
Very good morning to everyone. Am I audible? Yeah, it's real. That's what I have said to madam also. It's dream come true today for me. Because as a student, I have been number of times to SIRC. As a student, I have been studying in MD Educare or with MPVSR in the Primary Academy. I have been many times as a visitor, as an audience to Brahmaya Hall. And now, it's really privilege to learn from you all on this from this dais itself. Thank you. Thanks for this opportunity. Yeah, before this, I just want to show you one thing.
வணக்கம் சென்னை. தமிழர்களின் அன்பும் அறிவும் என்னை எப்போதும் கவர்கிறது. CA முப்பாலா சுப்பராவ் சார் அவர்களுக்கு என் மனமார்ந்த நன்றி. Thank you சென்னை.
Because you are the best evaluators for me, because I just don't know what I am speaking, but I think it's correct only. And anyways, vanakkam Chennai. Thanks for the coffee, nice coffee today's morning. Here coffee is famous in Chennai, I guess. So thanks the nice coffee. And before that, I want to thank Sweta Sharma ma'am for giving this wonderful introduction. Thank you, ma'am. And thanks to SIRC chairman, Uppal Subbarao sir, for giving this wonderful opportunity. We'll just dive into today's session as it is. We'll just discuss the CCFS scheme. I know many of you are already aware of this, and many of you are already using this scheme to just waive off your client's penalties and not penalties, late fees. Apart from that, in the March 2026, certain latest amendments were introduced by in the Companies Act. We'll also just discuss about it. Yeah. I have broke today's presentation or today's session into two parts with respect to CCFS, and the second one is with respect to latest amendments, wherein the CCFS, the scheme mechanics, certain routes have been described in the scheme. The AOC for MGT7, the traps, will just practically study why and all these traps can be done, and how we will be pulled into the institute disciplinary action with respect to CCFS scheme, and the immunity framework with respect to ROC and RD, the case studies, so that we can just practically understand the importance of this, and the UDIN also. You can think why UDIN has been going to be discussed in CCFS. We'll just discuss even in that in detail. Along with that, the part B, the latest amendments, amendment philosophy, the key recent changes, corporate laws, LLP amendments, and question and answers. Certain questions have been framed, so that at the beginning I have said you that I have come here to learn from you, not only just share from you, share to you. Okay, I am just proceeding. Yeah. This is the CCFS scheme mechanics which we have discussed. It was divided into three trenches: the regular filings, the dormant status, the strike off. Regular filing, if it is active filing companies, file AOC for an MGT7 for all pending years, pay only 10%, 90% is waiver. This is the regular filing trench. The second one is the dormant status, inactive companies, but in future we have plans. There will be a prosper in the business, we will be getting new projects, then we can opt for dormant status, convert into dormant via form MCS1. 50% is the fee and 50% is the discount. Okay, sir, I don't know that in future I may get or may not get the business. I don't have any prospect. Then go for strike off by filing STK2. It is dead companies. Dissolve cleanly via STK2 by just paying 25%, that is 2,500, and 75% is the discount. What exactly the CCFS covers and what it does not. The delay fees. The delay fees with respect to AOC for MGT7, 90% is the waiver. Primary benefit, file all backlog years. That's what I said. The delay fees only, the waiver will be there. ADT1, FC3, FC for the foreign forms, old forms, if applicable. For only those forms, the CCFS scheme is covered. The legacy compliance cleanup possible. Now, where it is not covered, AGM non-conduct penalty, section 96, section 99, separate liability must compound under section 441 via GNL1. This we will discuss in detail, but briefly I am saying that once you just don't give the AGM or don't conduct the AGM of any year, you are just doing the backlog filings, then late fee is getting waived, but it is a violation of section 96, where certain thresholds have been there. Within 15 months, the AGM needs to be conducted. The gap should not be more than 15 months. Certain criteria is there. As you have not met that criteria, under section 99, a certain penalty will be levied by the ROC. What is that? 5,000 per day is the penalty. 1 lakh on the company and 1 lakh for the officer and default is the penalty. Such kind of penalties are levied. So CCFS scheme won't waive that penalty. Adjudication penalties already discussed. When any order is come, adjudication penalties won't be waived off. The financial statements quality and accuracy, if the financial statements are not right, CCFS won't waive those penalties. This is most important thing, the CCFS scheme won't be applicable to LLPs. It will be only applicable to companies. Excluded categories. Companies facing already final strike of notice under section 248. If any strike of notice are already come, then CCF is not available. Companies that already applied for strike off or dormancy. If you have already filed STK2 or if you have already filed dormancy, then CCFS is not there. Companies dissolved through amalgamation, vanishing companies, listed companies for STK2, listed companies you can go for regular filings, can still use AOC for MJITSAN, but you cannot opt for STK2 route. LLPs, as we have discussed, it is not covered under Companies Act. Yeah. My car. Because I want my session to be very interactive. If you just listen like this, I may think that you are not listening, or my session is very bored. So that it's first morning session only. Hope everyone had a very tummy breakfast. I am not getting the response. Just a second, I am just coming. So that I want my session to be interactive, lively, not like this. That's what I said you. That it's an opportunity for me to deliver at the SIRC level. So I just want my day to be very big. Yeah. Coming to the next slide. The CA decision framework for which route? C. Is the business currently operational? Yes. Regular filing. If it is not operational, no. Then move to next question. Does the company have genuine future plans? Yes. Then go for dormancy route by filing all the backlog years. If it is no, I don't have any genuine plans for my future business. Want a clean exit with no future plans? Yes. Strike off. STK2. I don't have a clean exit for with no future plans also. These things. Then is the company on CCFS exclusion list? Which I have told you the list where our CCFS is not applicable. Yes, CCF is not applicable. Separate legal route. If it is not in exclusion list, then choose another route. The MCA versus version 3 portal. Revised certain AOC4 requirements. As this is effective from 14 July 2025, many of us are already aware of this. How many are into company practice? Only 2, 3. So many are just waiting for the opportunities, or we can just say that okay, chalte, why need to go with the companies practice. So yeah, as we are discussing ma'am just now, many are not coming into this routine practice, Companies Act, GST, income tax, but there are more and more avenues. Sir, artificial intelligence is there. Why can't we go into that avenue? Yeah, who said that we need not go? The first video which I have shown you, it is by AI only. I don't know Tamil, but I know Marathi. I know English. I know Punjabi. Every language in the world I know just because of this AI now. So I just use the AI with all the local subject which we have, the Companies Act or GST or income tax, whichever act we are practicing, we can just use this AI tools, simple tools. I'll just show even certain tools which are developed by our office. Only just yesterday when I just landed the flight, I just told my office, develop certain AI tool, so that whenever I just enter the figure and whenever I just enter the due date and all, it should come the output. What is the fee payable? How much is the savings which I am going to done? Or you have said that almost there are certain almost 117 sections has been amended in the Companies Act in March 2026. So as and when I click the section, you should show me old section, new section. So that is what AI is doing now. So AI is nothing but it is not any rocket science. Just as we know a simple English, through simple English only we can develop a Python code. So from Python code we can develop the apps. From the apps we can make our lives easier, because we are having almost 4,500 clients in the income tax, because my father is a senior chartered accountant and established from 1986. So we do have many number of clients, but we are more into routine works. So by giving these small tools to my staff, so that the work getting easier. Now as you know that we are not getting even the article students also. We are getting many, what we can say, nothing offense to anyone, but we are getting other kind of students who even qualified in their profession, but even they are not having the mindset of even our CA article, because our CA article can understand within 3 months, but they are taking almost 9 to 10 months. Even the qualified professionals, once they are learned everything, okay, jump, they are going into next office. They are looking for more and more opportunities. So rather than trusting our manpower, we can just trust our AI tools, so that our works get easier. Because this is not an AI session, but I just want to tell you that there are more and more avenues, and I want to make you all aware that these are the tools, and we can just go. Because we will be just discussing, just thinking that okay, sir is telling only Companies Act, what's new. So in that Companies Act, when we have the subject, the technology persons won't have the subject as CA have, but CA don't know the technology. When we can just learn the basics of technology, our subject can help in designing the tools which the software persons cannot do, so that we can just give our staff when any works. For example, many of you knowing about GSTR 2A and 3B, everyone will be hoping to know. How will you be doing the 2A versus 3B reconciliation? Of course, we need to do by filing GSTR 9 and 9C, or monthly evaluating at the end of the year, or if we receive any GST scrutiny notice or audit notice, we need to do. Then when I give to my article student, definitely they will take for almost 5 years, they are going to take at least 4 to 5 days. In my office they are taking 4 to 5 days. I just don't know about in your office, maybe in lesser day also. But with the AI tool which we have developed in our office, I am just uploading the Excels. Without even uploading also, I am just giving the GST login. So this is the GST login ID and password. You only go into website. You only just download that 2A or 3B or 2B, everything. You only give me the reconciliation. Hardly how much time you are thinking that the result will be coming? Any guesses? Any guesses how many time? Are you able to listen, or just within minutes, fraction of minutes? In my speech of delivery also, just in a fraction of 1.5 minutes, I could get the reconciliation statement. That is the speed of the AI now. After this 1.5 minutes, the result, we will be checking rather than 3-4 days of articles times. After this 1.5 minutes, we can make the article student to sit whether this is correct or not by sampling method. We just don't, by auditors, by doing the audit, we are in a much better position how to do the sampling. Sir, 10% sampling. Okay, go 10% sampling, do it. Even my articles itself are going without me involving also. They are doing the bank audits by taking the sampling, and they are starting 10%. Sir, how did you take the sampling? I will say, I will be asking. Sir, nothing, sir. A to Z I will give. I will filter from Z to A, or from the top to bottom amounts I will filter. Like that, the sampling is done. But I just don't know whether that is true or not. But even for getting the sampling done by giving certain parameters, we can just generate the sampling list with respect to AI also. That is the level of AI for which we can just go into with just basic tools. We need not be so technology friendly. So coming back to this session, hope everyone has got a certain revamp. Hope everyone are with me now. So nothing, as you said, this is not rocket science, just a Companies Act only. Because I will also get fear from along make with you fear. I will also be fear about these provisions, draconian provisions. These are all. When I am just going through, if I want to present you for 2 hours, I need to prepare for 1 day. Then I will be getting this tension. So what are these provisions? How many these lakhs of penalty? These are all. Okay, no problem. Chalte. With these AI tools, easily the lakhs and lakhs of penalties are easily leviable now on us. So we need to see how AI will also escape from the penalty. Coming back to today's session now. This is the thing. director's report, the separate, everyone, you will be knowing all these preliminary data. Much more important are there in the coming slides. The actual penalty which we have discussed. If any default in AOC for 10,000, 100 per day, maximum 2 lakh, MD, CFO, auditor deliberate. These are all penalties which I'll be sharing the PPT. You can just, these are all only basic provisions so that you can just go across. Yeah, this is the practitioner traps which we are discussing. The first trap with respect to AOC4. Sir, board resolution date must be after audit report date. MCA system flags illogical sequence. So this is one of the trap. With respect, I am saying with respect to CCFS. I'll just discuss in detail with respect to by just going to the case study. First trap. Krishna Textiles. This is all illustration purpose only. Krishna Textiles Private Limited. Old resolution disaster. A 3-year MCA backlog. Promoter Mr. Rajan arrives with a neat file of board resolution, all properly dated September or October of each respective year. Sir, everything is ready, sir. Just audit and file. Go. Nothing, sir. Just to see, everything is ready, sir. Please, sir. Then CA signs all the 3 audit reports on 15th June 2026. You didn't generate it correctly. But on MCA version 3 portal, with respect to financial year 22-23, the portal gives a response. Board cannot approve accounts the auditor has not yet signed. It is an illogical sequence. Without audited financials being approved by the board, we cannot proceed for filing. This is an illogical sequence. Only after audit report date, the audit report, auditors, the financial statements or audit report which has been adopted by the board only, it should be proceeded. So board report should be future date after audit report. What went wrong? Board approved the financial statements in 2022. Auditor signed in 2026. Old resolutions are worthless. Fix. Fresh board meeting held after 15th June 2026. New resolution for all 3 backlog years. Old resolution superseded. What is exactly the failure point here? Accepted the client's file without checking the dates. 3 filings ready to reject. CCFS window running out. The key lesson. For CCFS backlog, where audit is signed in 2026, fresh board resolution in 2026 are almost always mandatory. Check board date versus audit date before touching the portal, not after rejection. Many of you may be thinking, sir, portal response, as of now we are just going with the filings, but portal is accepting, sir, this is STP form only, there are no response. But in future, maybe not in future, I mean, maybe in couple of months only, maybe in the month of September or October, portal will automatically push a response before you are filing. So and so reason for rejection. So be very cautious. So like such kind of response will be there. So we need to rectify those responses before going ahead with a CCFS filing. Next trap. AGM held, audit done, only filing mistake. Only filing is missed. The cleanest CCFS case. Meenakshi Spinning Mills Private Limited, the honest defaulter. Coimbatore Textile Company, the turnover is 38 crores. So I done. AGM held, board minutes maintained, every paper, every year without fail. Promoter Mr. Salom's logic is, GST and income tax are important. MC is just paperwork. Result, 4 years of AOC4 and MGT7 pending. Additional fees accumulated around 2,80,000. This is just illustrative purpose. I just don't know whether it is 2,80,000 or 3,80,000 or 48,000 only. Example, certain CA has check reveals on one hidden problem. The CA has done the due diligence and she found out one thing. For the 21-22 financial year, audit report date is 28 September 2022. Board resolution date is 15 September, which we have discussed. Board should adopt the audited accounts, audit report. It should be on the same day of audit report or after the audit report, the board date should be. So, the board approved before audit sign. For financial year 22-23 to 24-25, audit report date is in October of each year. Board report is after due date, hence everything is correct. Fix. Fresh board resolution passed 2nd June for financial year 21-22. Dated 28 September 2022, the audit date. 3 minutes of work. All other years filed with original documents as is. Paid additional filing fees under CCFS, no section 99 penalty. All the things has been just fixed, so additional penalty is not levied. CA Mohan's original audit report, the UDINs remain as is. Sir, you have said that CA Priya, who is CA Mohan now, he is the chartered accountant who has signed the audit report and generated UDINs. CA Priya has just making the filings with the certification. 2 UDINs per year, it is always mandatory. 2 into 2 forms, 4 years. So 2 into 2, 4 into 8 years. These many UDINs needs to be generated. AGM held 099 exposure, only filing missed. CCFS is your cleanest case. One date sequence error hidden in year 1, caught by a 5-minute check before the portal did. This is the second trap which we need to clean up ourselves before moving into the CCFS. Next, trap 3. Audit report date is equal to actual signing date, not year end. What exactly is this? CA Suresh signs financial year 23-24 audit in July 2026. Assistant puts 31st March 2024 as report date. Looks cleaner. CA signs without checking. UDIN portal asks document date. Enter 31st March 2024 by oversight. Is it correct? If we are just making the UDIN generated on 15th June, can we make the audit document date as 31st 3 2024? This is the trap. We may not do, but our article students, now as we discussed that we are not getting articles, the staff who are not having much of knowledge, they are just entering the document date as whatever we enter, the UDIN will be generated. Na? So whether it is correct UDIN or wrong UDIN, we may get a notice in the future. Until then, we will just saying, sir, UDIN is generated. So nothing error has been done. So such kind of mistake only was done. Audit evidence was collected in 2026, but opinion says as of 31st March 2024, entire audit process was misrepresented. What should have been done? Audit report date is 12th July 2026. UDIN document date 12th July 2026. Board resolution any day after 12th July, or even if it is 12th July also, no problem. The year end date on audit report is the reporting period, not the signing date. These are two completely different fields. Never confuse financial year ended 31st March 24 with report dated 31st March 24. Our report date is 12th June 2026 with respect to financial year 31/3/24. This is the one more trap, because whenever any such kind of income tax amnesty scheme or GST such kind of amnesty scheme or such kind of CCFS windows, they will be only for shorter period. So there are more chances of us getting involved into these kind of traps, maybe unintentionally also. So before that, we need to check all these. The trap 4, auditor changed between backlog years, attach correct ADT1. This is a regular case only, because auditor on rotation he may change, or due to certain unavoidable circumstances they will be changing the auditor. At that time, what needs to be done? Balaji Pharma, a 5-year backlog. CA Krishnamurthy audited on financial year 2021 and resigned in September 2021. CA Venkatesh appointed from October 2021. CA Venkatesh files for all 5 years under CCFS. Enters his own name as auditor for 2021 and attaches his own ADT1. As you know that clients won't give the information of previous auditor and we don't obtain anything. You may say that, sir, just by paying 100 rupees we can just download the public documents and we can get the said. As I said, in the CCFS window, very short, this is 3 months. Now, as you know that every client will be coming under flag end only, just 2 days before the CCFS closes, then we don't have the time of downloading the public documents and getting the data. So such a kind of traps will be occurring. MCA flags, ADT1 on record shows CA Krishnamurthy for 21-21, filing inconsistent with auditor appointment records. Fix. For financial year 2021, must show CA Krishnamurthy as auditor with his report. If retired or untraceable, board must appoint CA Venkatesh via casual vacancy. Fresh ADT1 for that year. We should not say ADT1 is for another auditor and you should not say yourself as auditor of that year. Key lesson. AOC for auditor details must match with the auditor who was appointed for that year, not the CA who is currently doing the CCFS filing. Each year is independent. Each year's ADT1 must be correct. This is one more trap. The trap 5. XBRL filers. Signed financial statements mandatory attachment. Hope everyone will be knowing when XBRL is required with respect to filing. Certain thresholds are there. Only after that threshold, XBRL filing is mandatory. Coromandel, we will just discuss with an illustration. Coromandel Engineering Limited. The 9 PM panic, which we have said. It is an unlisted public company. Paid up capital is 8 crores. Turnover is 145 crores. XBRL is mandatory as the threshold has been crossed. It is a 3-year backlog. CA Deepak completes everything. Files on 14th July because I think the information was received on 13th July or 12th July only. So, we will be filing on 14th July. Portal issues a warning. I am just saying that warnings will be received in future, but in advance I am just showing what kind of warnings you may receive in future. Portal says mandatory attachment missing. Section 134 authenticated financial statements hard stop. MD in office, CFO traveling, CS in Hyderabad. Only the chartered accountant who needs to do for the company only is free. Everyone are busy. That is the case here. MD is in office, CFO traveling, CS is in Hyderabad. Financial statements, sir, send via WhatsApp. Printed, signed, scanned, everything is done. But portal rejects. Say that poor scan quality. SRN generated 11:52 PM on 15th July at night. So everyone will be having their own sleep. We will be busy doing their company's work. 8 minutes to spare. Other 2 backlog years missed entirely. Because for first year itself we took this much time. By about the remaining 2 years, the full fee is payable. The client will be paying. Additional check. XBRL tagged numbers must match it. Signed financial exactly. And any difference, cross check failure. This is one more thing. The serial number in the financial statements is 1 and the XBRL will be another. Again the numbers won't match. Again it throws an error. The mismatch in the serial number. Everything needs to be rectified before going into CCFS filing. Key lesson. Signed financial statement is the gate to enter. It is not paperwork. Identify all signatories on day 1. Allow 2 weeks for signatories logistics. Never attempt XBRL filing in the last week. This is one more trap and one more suggestion. With respect to trap 6, reconstructed books, honest opinion, need not be clean opinion. This is one more regular case. For last 5 years, for some or the other reason, the client is busy, the management busy, the audit is only free. So no books, no nothing. Yes sir, for 5 years they will be just saying. I will just explaining with an illustration. Sunrise Hospitals, a 5-year backlog, no books, only 3B bank statements. CA Prakash signs clean unmodified opinion for all 5 years. CA what he will say, sir, just to prepare accounts from GST returns, sir, bank statements, sir, sign and file, 22 lakhs become 2.2 lakhs it seems. That's to 2.2 lakhs. I will pay you good fees also, sir. For 5 years, no fees, nothing. Now he will say good fees. What is that good fees? I just don't know. Maybe 10 rupees or 15 rupees. NEFRA inspection. How did you verify debtors, creditors, inventory, not available? Then why is your opinion unmodified? This might be the case with respect to NEFRA questioning the chartered accountant. Disciplinary proceedings, career risk. 2.2 lakhs is the CCFS paying for the client. The professional misconduct finding is with respect to the chartered accountant. Rule evidence. Evidence adequate, unmodified, emphasis of matter, material items unverifiable, qualified or disclaimer. Never clean opinion on unverified data. Key lesson. CCFS saves the client's money. A false clean opinion costs the CA their career. The client saving is not your saving. Your risk is your own. SA 500 does not have a CCFS exception. In SA 500 there is nothing there. Sir, if you file under CCFS, then chalte, no problem. Like that, nothing was there in SA 500. So, auditor should be very careful. With respect to AOC4, we have studied 6 traps. So hope everyone understood. So what kind of traps we are going to see in future after this CCFS filing is over with respect to AOC4. Now with respect to MGT 7 or 7A, certain thresholds are there. For financial year 21-22 to 24-25, paid up capital 4 crores and turnover 40 crores, the threshold for small company. Now the form selection is MGT 7A if it is small, MGT 7 if not. For 25-26, paid up capital is 10 crores and turnover is less than or equal to 100 crores. MGT 7A if small, MGT 7 if not. There is certain revision in these threshold also, we will just discuss in the amendment section. Penalty, which you are discussed in AOC for also, the 2 lakh cap. Here for MGT 7, the cap is 5 lakhs. Every officer and default it is again the 5 lakhs, 100 per day up to 50,000. This is the thing. Here also the traps, we will just discuss the traps. Trap 1, the same 6 traps only, we are just discussing in detail with an illustration. Wrong shareholding data year wise. Venkatesh Polymers Private Limited, it is the most interesting and very regular in our practice, the copy paste. We are all habituated with copy paste. So this is the copy paste disaster. A 4-year backlog, 2 promoters, Mr. Venkatesh 60%, Mr. Suresh 40%. In 22-23, Mr. Suresh transferred his entire 40% to his son, Mr. Karthik. Mr. CA, Deepak prepares MGT 7 Excel template for all the 4 years. Pressed for time, because as you know, in the last minute only the clients will come. Pressed for the time, copies current shareholding into all the 4 years. Later shareholding you have seen 60% Venkatesh, Karthik 40%. So like this only it will be for the last 4 years also. So copy paste. For 21-22, filed by CA Deepak as Venkatesh 60%, Karthik 40%. But what is correct? Venkatesh 60%, his father Mr. Suresh is 40%. MCA already has SH4 on record. Whenever the share has been transferred, SH4 needs to be filed through MGT 14. So MCA has already those records where SH4 has been filed. Showing Suresh held shares until 22-23 only. Cross check fails. 21-22 and 22-23 MGT 7 show Karthik as shareholder before he even acquired shares. Result, filing was accepted by the portal but wrong data filed. ROC scrutiny post CCFS. Fresh notice is issued. CCFS immunity gone because what was filed was factually incorrect, not just date. This is the thing. Yeah. MGT 14? No, sir. It is applicable. For private limited companies, it is applicable. Sir, there are only certain exceptions. No, sir. If it is above 100 crores turnover, or if it is not a small company, then MGT 14 needs to be filed. You need to correct me if I am wrong, sir. These are the certain conditions are there where private limited company needs to file MGT 14. And with respect to board resolution, straight away they have removed. But with respect to special resolution, we need to file MGT 14 even for private limited companies once we cross the threshold, which was given by the Companies Act. This is the case. So generally with respect to SH4 share transfer, client, though MGT 14 is not required because SH4 needs to be done in a board resolution only. Though SH4 board MGT 14 is not required at that scenario, just for client purpose they are asking us, sir, what are the records available in MCA? Because client is the shares transfer from one share to another share, they are giving almost 1 to 10 crores. So what is their evidence? That person is asking, sir. So at that time we are filing MGT 14. So that certain evidence is getting filed in this thing, and we will just show the document. This is already filed in ROC website. So for this case also we can file MGT 14. So it will be a cross check now. So hope you understand the copy paste disaster. These are the copy paste disasters. In future this copy paste disaster also. Now you are just seeing after this thing you may after filing you may get a result that this is the thing. But what I want to say is an MCA version 3.0, already many of us are experiencing in income tax faceless scrutiny, faceless appeals. Am I right? Similarly, in ROC also we are going to get any faceless scrutiny. Any one of you have already received any notice from the Companies Act from RD or ROC? I think I am the lucky one. My client has received from with respect to ROC from faceless. So these are not too away. Everyone will be now in income tax. Everyone are experiencing that there are more and more work but no revenue. So it is not only my feeling. Hope everyone's feeling. Am I right? Because of this technology, the faceless notice we are getting day in and day out. Sir, this is the thing. We are some or other kind of notice are coming into our inbox. The client will be saying, sir, this is separate assignment. Sir, notice only from past 30 years we are thinking this thing. Sir, your mother has cooked me food. So, no, why come fees, sir, 250 rupees? For 1 hour he will talk. At the end of 1 hour, he will only win without giving the 250 rupees extra. So, this is the case. Chalte. That's what I am saying. We need to move into more and more new avenues, unlike the traditional practice. This is the thing. Notice will be auto fetching with faceless scrutiny in our MCA version 3.0. The second trap, resign or decease the director in backlog years. Annamalai Constructions, the ghost director problem. This is 3-year backlog. Originally, the 3 directors. Annamalai is the MD, Mr. Prakash is the director, Mr. Sundaram is the director. Mr. Sundaram passed away in November 2022. DR12 for his vacation of office was never filed because we were never told that so and so director was already, he was passed away, and we were never given the death certificate also. How can a chartered accountant can file the DR12? MCA portal still shows him as an active director. CA Meena begins CCFS filing for 22-23, MGT7. She lists only Mr. Annamalai and Mr. Prakash as director. Because now at the time of CCFS filing, we know that he already passed away. So we have removed his name from MGT7. Mr. Sundaram has been omitted because he was deceased. But the portal flags. MCA records show Mr. Sundaram as active director through financial year 22-23. MGT7 does not mention him. Inconsistency is detected. Separately for 21-22 MGT7, Mr. Sundaram must appear as director. He was alive and serving till that date. CA Meena has omitted him entirely for 21-22 also. Both filings were defective. Fix. Before MGT7, filed DR12 for Sundaram vacation of office due to death with the death certificate updating MCA records. Then filed 21-22, MGT7 showing Sundaram as director. Filed 21-23 for MGT7 showing Sundaram served April to November 2022 and vacated due to death. The time lost. DR12 processing takes 3 to 7 working days. If discovered on filing, CCFS window pressure. Fix. Check MCA master data for every director before starting CCFS work. Flag deceased or resigned directors immediately. File DR12 in first week, not in the end of the CCFS due date. MGT7 must show all directors who served during the year, including those who resigned or died mid-year. MCA's own records are the cross-check. Resolve DR12 gaps in first week of CCFS engagement, not on filing day. Hope everyone understood this trap, the practical trap. Trap 3. SBO declarations pending the beneficial ownership interest. If the declaration is pending, it blocks MGT7. We'll just discuss. Lakshmi Agro Industries Private Limited, the silent SBO blocker, profile 3 years backlog. Mr. Ramesh holds 15% directly plus HA of 12%, wife 18%, 15 plus 12 plus 8, 35%, effective beneficial ownership. Ben 1 never filed. Nobody knew SBA rules applied. CA Suresh completes reconstruction, audits and board resolution. Everything is ready. Begins MGT7 filing. But portal throws an error. Shareholder with 15% direct holding detected. Ben 1 declaration expected on record. None found. MGT7 shareholding data inconsistent with SBO compliance status, which I already discussed. Sir, as of now, ROC is not throwing any errors, such kind of thing while filing. Why this? That's what I said. In future, in coming months, these kind of errors will be given before filing itself, so that it will be a warning also for us. Okay, no problem. Like such kind of thing can be done. CA, what does CA? Sir, you need to file Ben 1 showing total 35% beneficial interest, direct plus HF plus 5, required since 2018, never filed. But what Mr. Client says, sir, nobody told me, sir, how come? Even if we tell, he will say that nobody told me. That is the reason in our office, we will make every communication through email. Not, phones will be done, but email is mandatory, because client will be saying, sir, you didn't tell me anything. Sir, you didn't tell me about this thing, that thing. So, email communication is this thing, so that you can just check in your inbox, sir, we already informed you. What must happen first? Ben 1 filed by Mr. Ramesh disclosing 35%, that is the total 15, 12, 8%. Ben 2 filed by the company intimating ROC about the SBO. Though these are outside the CCFS, separate filings, separate fees needs to be paid. No CCF amnesty is there for filing these forms. Only after Ben 1 and Ben 2 are processed, MGT 7 can be filed cleanly. What is the key lesson? SBO is a gate, not a formality. One missing Ben 1 blocks all MGT 7 filings. For that company, checks SBO compliance on day 1, not filing day. This is the key lesson from this third trap. Next one, fourth trap. Yeah, please. Sir, as of now, Ben 1 needs to be filed every year, sir. But there is an amendment with respect to this Ben 1 in 2026, which we are going to discuss, sir. Ben 1 needs to be filed, or Ben 2, as the case may be, needs to be filed only when there is a change in the beneficiary interest. From March 2026, that amendment has been introduced, sir. That we will be discussing that. But as of now, we need to file every year.
Every year.
Hope you understood, sir. Yeah. We'll just move into the next trap. The trap 4. Wrong form for wrong backlog year. MGT 7, 7A. This is one thing. Venkatesh agencies, the turnover is 38 crores in 21-22, crossed rupees 42 crores in 22-23. CA files MGT 7A for all 4 backlog years. Small company form using current year classification. Many of might have already experienced this. In financial year 22-23, company was a not small company, because the threshold of 40 crores was already crossed. MGT 7A was wrong form for financial year 22-23. CCFS immunity does not apply to wrong filed forms. ROC issues notices after 15 July for correct MGT 7. Full additional fee, no CCFS benefit. Form selection rule, that we have discussed. 21-22 to 24-25, we need to see the threshold of 4 and 40 crores below it is or not. From 25-26, 10 crores and 100 crores. Apply each year's threshold to that year only. Key lesson. Wrong form, no immunity. Even if filed under CCFS, verify threshold year by year, not once for all backlog years. Company currently small was not small in backlog year. Through portal, MGT 7A may get accepted, but wrong form, it is filing defective. Everyone must have already experienced this. The trap 4. The trap 5. The GPS photo of registered office not ready on filing day. Now, the MGT 7 or 7A is asking for this mandatory attachment of photo with a GPS location. CA Deepak has 18 CCFS clients. Filing day, calls each client, sir, send office photo. Client sends interior photo, old photo, WhatsApp compressed image. Portal rejects all 3. Second client, for registered office shifted 2 years ago. Address updated at MCA, but photo and GPS of new officer were never corrected. Portal requires current exterior with visible signboard. Third client, registered office sees CS own address. This is one more beautiful. Our own address we will be giving to a company. The client, sir, use this. Because for that company, there are no proper proofs, it seems. No municipal tax receipt or current bill. So, we will be giving our own address. No company signboard displayed there. Photo cannot be taken. Address must be first changed to actual office. Time wasted on filing day. When CCFS window is closing, GPS coordinates of wrong location, filing flagged for an inconsistency with MCA records. Collect exterior photos, GPS on day 1 of CCFS engagement, not filing day. 10 minutes upfront saves 2 hours of panic later. You may any of you might be saying, sir, this is HTTP form only, na? We can give GPS coordinates. Some in a Google we'll just type some coordinates will be coming. In now you are saying artificial intelligence also, no sir. In a AI, if we just say this is the prompt, sir, we want a photo. This is the thing. Just to give me a photo with GPS coordinates also. Yeah, it will be giving beautiful photo will be giving, and we can update. That's what I am saying. We are not saving client. We are just making our hands to burn. That is what. If we are going to save the clients by giving a wrong data, then later we can't even expect what kind of this thing will be coming to a chartered accountants. So never try these kind of things with respect to saving the client. We can save the client. That's what with madam we are discussing. Sir, nowadays the client are asking rather than compliance practice, some certain value addition they are expecting from us. So this is not the value addition which we are giving. This is the wrong idea. Using these latest tools, we can give value addition. There are certain number of avenues by giving value addition. Don't risk our own profession by giving wrong advice to the client. The next trap. Disqualified director DIN, block MGT7, not AOC4. What exactly is this? Srinivasa Constructions, Mr. Venkat, MD, active DIN, Mr. Suresh, director in another company with 3-year filing defaults. AOC4, okay, chalte. Sir, I think even with disqualified director details also, AOC4 is going. So, AOC4 chalte, no problem. But Mr. Venkat signs with active DSC, Mr. Suresh doesn't sign. Portal does not check non-signing directors, filed successfully. In MGT7, we need to give all the director details. All serving directors must be disclosed. CA enters Mr. Suresh DIN, portal access, check every DIN list. He is disqualified under section 164.2. As we have discussed that, he is a director in another company which has a default 3-year filing. So, he is disqualified. Now, what is the recourse? Go to respective high court, file a writ for DIN restoration. It will take not only weeks, it will take almost 4 to 5 weeks also. Discovered on filing day, CCFS window is closed. Full fees. Discovered day 1, petition filed immediately, CCFS preserved. To discover on day 1, the client should be coming in well in advance. He will be coming only on the last day. So, how can we, that is what this thing is different from practical. The economic is different from practical. But as I on dais, I need to tell, sir, this is the practical things, this is the advice which we need to give to our own professionals. Because I am also learning from you all, because I do have certain CCFS filings, because with respect to ADT1 only, I am just share you one thing. With respect to ADT1 only, I have almost 82 clients. ADT1, because till day the clients won't pay the fees. So, we are just not bothered of filing ADT1. We will just file till day we used to what Z89s in the place of SRN. Z9999. Okay, chalte, no problem, it's going now. But from last to 25-26 also, financial year, without giving mandatory SRN number of ADT1, without giving the correct SRN number, it is not moving forward. So, using this CCFS, I am filing ADT1 of almost 82 clients now. I am now, earlier when I asked, I am just asking Chalana payment fees. They are feeling as if they are paying to the auditor. So, as in the mail which we are clearly writing, sir, this is the Chalana payable to government, not auditor fees. Even when they just they'll phone pay or Google Pay, in the narration they'll say only one thing. Yeah, please. Yeah.
So, but MGT7 and AOC4 you have already filed. of those backlog years.
True.
So we have to again file AOC4 with the new ADT1 SRN number.
Yeah, your excellent question it was. AOC4 and MGT7 has been already filed.
Yes.
ADT1 by keeping Z89s of ADT1.
Yes.
That is the case.
Yes.
Now with respect to backlog years, we are filing ADT1 of ADT1 presently.
Correct.
We are just keeping in records. We are not filing AOC4 and MGT7 again.
Okay.
We are just keeping in records so that in future when any notice comes, we will say that at that time ADT1 is not mandatory, sir. Now it is mandatory. So we are filing. That is the case.
So, but ADT1 was always mandatory, no? Like what happened basically?
In the act, it was mandatory, but in the technology thing, it is not mandatory.
We can write Z999 and we can
Z89s, that's what. Even in the GST also, I am just facing these kind of issues. Not only me, many of us will be facing. There will be certain amendment in the GST Act, but portal doesn't show.
So you are saying ADT1 we can file from the correct year and keep it for records and not to revise.
True, we need not revise because at that time the portal did not push us to file ADT1 compulsorily to give only correct SRN number. Now we are giving the correct SRN number. I am just not saying that it is correct, but it is the only option now for us. At least now we need to clean. Otherwise there is no option. If you see the CCFS circulars, which I'll show you, at the end they used one beautiful line. We are giving this window until 15 July 2025. Whoever uses this window to clean your books, they will be almost safe. But who doesn't use this window to clean, you will face the consequences. Such kind of word has been given. So we can expect, every one of us can expect in future what kind of notices will be coming from the MCA. So this is a cleaning procedure. The CCFS window is a cleaning procedure. The trap 7. CS signature missing for years where CS was mandatory. Priya Pharma, a paid up capital, crossed 10 crores in 22-23. CS appointment was mandatory under 203. From that year, no CS appointment, nobody flagged it. CA Ramesh files MGT7 for all backlog years, for all 4 backlog years. Signed by MD only for financial year 21-22, below 10 crores, portal access director only signature. But for 22-23 onwards, portal flags paid up above 10 crores, CS signature is mandatory, MD only signature required was done, so it is rejected. 3 year of MGT7 was stuck. Deeper problem, CS was never appointed, separate section 203 default, must be compounded under 441 by filing GNL1 outside the CCFS entirely. So this is one more this thing. But earlier you might have already experienced certain active form was there. Now even now also it is there. But when initially introduced that form, it is what I felt is that form when it was introduced, what I felt is the form was not for the purpose of cleaning the company, but for the purpose of cleaning the professional who is going to file. Because no ADT1, no company secretary, nothing was there. But the forms are going till now. Till then there was no objection. But only when the active form was introduced, many lapses. Till the at that time only I also came to know that what these many pending things are done. Pending things are there. So we did all the pending things. So later on the thresholds has been revised for active form filing needs to be done. So such kind of thing. Now using this window, we will just clean up everything. What this trap 7 also, for the trap with respect to AOC4 and the traps with respect to MGT7 we have discussed. Which any one of you have remembered similar scheme was introduced in 2020. What the scheme is called? Anyone have an idea? Listening or it's I think CFSS. Am I right? Certain scheme was there in 2020. It is called more of a CFSS scheme we used to call as COVID relaxation scheme. So many used to undergo into that scheme. But I found the 2020 scheme is more beneficial than 2026 scheme. What was the reason? Only here, only filing fees is waived, but up to only 90%. But there 100% waiver was given, even not only for filing fees, even for penalty also waiver was given at the time of 2020. But now in 2026, only late filing fees were there. So simply this scheme is only to clean up our books, nothing else. So penalty, consequence, everything we need to face. Moving forward, the other trends which we have told. Okay, sir, now active, the company is active. So just to go file AOC4 and MGT7. Now as of now we are not active, but in future there may be business. Then go for the second route or second trend, that is dormant company. What is dormant company? It is not a closed company, remains on MCA register, can be revived at any time, status dormant on MCA portal, files dormant annual return each year. It is very simpler. MCS3 it is very, MSC3 is very simpler. What are the preconditions? Clear all pendings, no significant accounting transactions in past 2 years, outstanding SBO declaration must be filed, no pending education orders, ROC then convert company to dormant status. The sequence, CCFS cleared, then MSC1 is accepted. Both benefits can be used sequentially. That is the thing. With respect to second tranche MSC1. Sir, the third tranche. Sir, I don't have business now. I don't know whether I will receive the business in future. I may not receive any projects in future. Then strike off. CCFS benefit. Pay only 25% of STK2 filing fees. STK2 application. Form STK2 signed by majority of directors including MD or whole time director. Yeah. Yes. If you are going to dormant.
And then every year I have to file
MSC3.
MSC3. Correct.
For annual return.
Wow, annual return. Okay. Right.
Oh, I'll just proceed. I'm just briefing what exactly when we are going to next tranche. Well, just briefing what are the exact positions of the STK2 or dormancy status. STK2 signed by majority of directors, affidavit filed by each director. STK3 indemnity bond. STK4 every director individually. Statement of accounts, no specific form, not older than 30 days from STK2 date, certified by CA in practice with UDIN. What are the preconditions for STK2? GST registration certificate needs to be cancelled. Bank account should be closed. All TDS demands should be settled. No legal proceeding should be active. It should not be a listed company. That we have say STK2 exclusion. Listed companies cannot use STK2 route under CCFS. This is the preconditions with respect to STK2 application. So everything. Many of us, the clients used to say, yeah, please. Adjudication. That is which we are going to discuss in the coming slides. With respect to adjudication, you just keep your question in pause. Once we will just going through that slide also. If you still have that question, you can just ask me.
Yeah. 7 or AOC4 in the past years, can he still go for STK2?
That is what earlier until 2023, I guess. Without filing any backlog years also, STK2 is permissible.
I mean, from 2018, from 2019 until date,
yeah,
he has not filed any compliance of ROC. Still, he can file directly STK2 or he has to comply everything and then STK2?
Till 2023, I think, or 2023 mid, STK2 was permissible without filing all the backlog years.
Okay.
But since that date, without filing the backlog years, without keeping your records up to date, you cannot file STK2. No, this is the case.
Okay.
Hope you understood my point. This is the thing which you are asking me?
Yes, sir.
Okay.
Actually, I have certain clients stating that they have not filed any ROC compliances from 2018 till 2023. So, which is better? Like, can I directly file STK2 or I have to file?
Now, as of now, what is the status of the company?
It's not running.
It's active only? It is showing active or it is already cancelled?
Cancelled in the sense? It's not running any business.
It's not running any business.
No
but
revenue
if
from
a company
operations.
doesn't file for more than 3 years, government or MCA will automatically cancel through strike off route. Once the automatic strike off cancel has been done, who are the directors are there in that company will be disqualified for a period of 5 years. That was the case. So, if already the company was already struck off by MCA, then you cannot go for STK2 route.
No, it's not striked off.
So, still active.
Yeah.
If it is more than 3 years, company should automatically struck off. Why it is still active in your case? Is there any charges? Any
no.
bank loans?
Maybe bank loans.
Might be. Even for that bank loan purpose, the MCA wouldn't have struck off.
But it was not updated in the MCA portal that they have any bank ODs or loans.
Without updating, index of charges should be registered, right?
They have not registered.
Without registering the index of charges, the already MCA would have already struck off the company.
No, it's still active.
Maybe in many of our clients, it was already struck off. If we didn't file for 4 years, 3 to 4 years also.
So can we still wait for 1 or 2 years till they strike off, because they will get huge penalty also, right?
This is the on the dais I shouldn't talk this thing, but I do have certain this thing. We used to practice these kind of things because we need to pay in lakhs. Because of this scheme, now we are just paying 90%, but we need to pay in lakhs. So for that, we do have other options also.
Achha.
Because across the forum, I shouldn't talk, and
Okay,
that too it is recording now. I shouldn't talk.
Okay, sir.
But there is once after this forum, we can just discuss. After.
Sure, sir. Thank you.
With respect to STK2, which we have discussed now, the third trend, the third route, which we have discussed, the immunity framework. The filed before any ROC adjudication notice issued, yes, 10% benefit was there, full immunity, ROC proceedings was concluded. With respect to your first doubt, this might give you a good impression on this. Filed within 30 days of ROC adjudication notice, yes, the 10% benefit was there, full immunity notice becomes infructuous because we have filed within 30 days of ROC issuing notice. Filed after 30 days, we are going to file on 35th day. On 30th day or 31st day only the client comes. Sir, we have received this notice, sir. For maybe 30 days back only we have received. I was in Goa trip with family, so I don't know with this notice. My accountant also doesn't know anything, sir. He just forwarded you the mail. I just don't know. You also didn't see the mail, sir. So again, he will only push this thing. So the file after 30 days, yes, still CCFS immunity with respect to filing fees was there, but no immunity with respect to ROC will still pass the order. ROC will pass the order. He will levy the penalty. No penalty is waived off with respect to CCFS. 30 days was lapsed. Order also was given. Then comes the client now. Sir, order was given. In ROC, the future amendment is coming with respect to 454B, I guess. I mean, they have begged forward the provisions from the income tax with respect to once the demand has been risen, they will attach the bank account, they will freeze our accounts, everything. Already we are facing in income tax. Now in ROC also 454B amendment is there with respect to this thing. So once the bank statement comes, the manager calls, sir, your account has been freezed, what to do? Then the client will realize that an order has been pending before us. Then he will run to the client, sir, CA. Sir, what to do now? If it's the CCFS window is open, you can go with filing but there is no immunity. Penalty in order must be paid in full. So you can pay or you can go for appeal. Once 454D also was introduced, we will just discuss even that also. Once adjudication order was already issued, what is the remedy which we are available to the client? CCFS can be filed even after an adjudication order. 10% fee saving is still available. Never tell clients with existing orders that CCFS is pointless. This is the thing. Hope your question has been solved with respect to adjudication order only which we are asking. GST appeal is pending. Good point. You need to GST appeal pending means STK2 whether they can file STK2 or not, which we have discussed earlier also. No active legal proceedings against that company before filing STK2. This is the case. Even if file STK2, it will accept, okay, it will take time. But once GST order will be issued, at that time, if the officer found that STK2 has been already filed, then there will be rigorous provisions against the company, because under Companies Act, they can go for up to 7 years before also. Though even if you cancelled by filing STK2, you can't be saved. What immunity will not cover, which we have discussed? AGM penalty, 96 or 99, fraud or misrepresentation. If it is a fraud case, then sir, CCFS window is there. CCFS window is there only for legal provisions. If you are correct only, then CCFS. Prosecution already filed in the court. If prosecution was already filed in the court before CCFS filings, it proceeds completely independently. CCFS cannot stay or withdraw court proceedings. That is what. Another thing is quality or accuracy of the financial statements. The financial statements itself is wrong, CCFS cannot save us. Yeah. You are talking about section 99.
Yeah, section 99.
That also amendment was there. You please continue. No problem. Tell me.
If AGM was not conducted and I'm conducting AGM as on date, then the compounding fees will be up to 1 lakh, or
No.
it might be compounded.
1 lakh per annum on the officer and every officer in default and the company, and 5,000 per day. Now there is an amendment. There was a cap also. 1 lakh maximum. That is the 2026 amendment. Still it was not implemented now.
But it states as up to 1 lakh and up to 5,000. So
Up
it
to
means
1 lakh
that
per
is
annum.
cap. Huh.
Up to 1 lakh per annum.
Per annum. So from 1819, if it is not conducted, so assuming it is 5 years, then it is 5 lakhs.
5 lakhs per
And it
every
will not be
officer in
compounded.
default and company.
Okay. And what about that 5,000?
5,000 per day. The default. Now everything has been come into one bracket. 1 lakh is the maximum limit
Okay.
in the 2026 amendment which we have brought in.
Okay, sir. Thank you.
Thank you. Moving forward with the next slide. We'll just discuss the case studies which we are already discussing. The case study Active MSME, the 3-year backlogging. It is a manufacturing MSME, the turnover 45 crores, MCA ignored 3 years. AGM was also not filed 3 years. Almost everyone will be knowing what exactly this, because these are all practical cases which every one of us are already experiencing. Client says, Anna, file quickly. In Telugu we used to say Anna, but in Tamil I just don't know. So this was also yesterday, our SIRC staff were asking us, sir, please share the PPT well in advance. I said, sir, PPT was not yet ready, sir. Yesterday before landing also was not ready. I just pasted entire material or prompt in Claude. It's Opus 4.A, where the hallucination is only just 13%, which was excellent. So yesterday night after landing in the hotel room only, I could able to prepare this PPT. I just don't know how much correct it is. I think it was almost correct, because almost every point which I have written in the prompt was presented in such a beautiful way. Even even if I sit manually also, I couldn't prepare this PPT in such a beautiful way. Claude Opus 4.8 has been this thing. So we can give a good round of applause to Claude 4.8. Claude this thing. So this is A, the power of A, the Opus 4.A. And today morning only I read a news article that already in the artificial intelligence, it has just coming out of our hands. It is only preparing its own duplicate version also. The A. So we are stop releasing newer versions. So we'll just sit with older versions till now. We'll just don't give the 87% accuracy means. Just imagine how much is the level of AI with this thing. Almost, if next version is reached, it will be almost 90% accurate. With hallucination only 10%. So as of now only it is making the duplicate version of its own herself without intervention of the human. So they are unable to control the AI. So they are just stopping today's article, but I just don't know whether they will stop now or the discussion in progress, or we just don't know. what the client says, Anna, file quickly, Anna, only 10% pays, pay 20,000, the 2 lakhs is the penalty, na? Pay 20,000 and done. Chumma, that's it. But what the CA must actually do, which we all discussed till now in the earlier slides, verify books of all the complete 3 years, not just GST returns. Check the director DIN status, any 164(2) disqualification. If 164(2) disqualification is there, which we have discussed, file a writ in the High Court, get the director DIN activated, then proceed for filing. AGM default. CCFS does not cover section 99 penalty. Separate exposure. Conduct proper audit. Sign on actual date. Generate UDIN on the same day. File CCFS. Pay 20,000. Save 1,80,000. File separate compounding application under GNL 1 for AGM defaults under section 441. This is one more interesting. This thing is what we should never, always tell to the client that you are going to save only late phase, but penalty is already there under section 99. So file compounding application. Whether he will listen and file a compounding application or not is secondary. But as a chartered accountant, we should make them aware. As I said, you just to drop them a mail saying that this is the fees which we have saved through CCFS, but still penalty is leviable and compounding application needs to be filed. So that in future, he may say after 5 years, sir, we have already paid almost 2 lakhs. He paid only 20,000, not 2 lakhs. But he will say that we have paid 2 lakhs. Sir, we have paid 2 lakhs. We have cleaned everything. We have up to date. But why still penalty is coming? Did you take any amount of it? He may ask. So at that time, a mail will be our rescue. CCFS benefit is real. Hidden AGM exposure is bigger. CA must warn client in writing. Undisclosed AGM penalty, professional failure. This is what a single line in a mail will save our skin in future when a client receives notices. The 5-year default, reconstruction and risk. We already discussed. 5 years, for the past 5 years, no financial statements, no AGM, no MCA filing. Additional fees without CCFS is approximately running to 18 to 20 lakhs, and with respect to CCFS, it is only 10%. So 1.8 to 2 lakhs is the fee payable. Reconstruction standard. Revenue is built from 3B output data. Purchase with respect to a counterparty declarations. Bank reconciliation every year from bank statements. 3-way reconciliation. 3B versus revenue versus TDS. Minimum standard. But audit report outcome, all evidence obtained and verified, unmodified opinion and emphasis on matters, SA 706 for reconstruction. Material items unverifiable, qualified opinion or disclaimer. Never give a clean opinion on unverified reconstructed books. Cross system check. This is the future algorithm which MCA is going to build. AOC 4 shows 55 crores turnover, but 3B shows 72 crores turnover. MCA algorithm mismatch will flag this gap. CCFS saves 16 to 18 lakhs. A clean opinion without adequate evidence, a career risk. The saving and the risk are not comparable. This is the second case study. Case study 3. The selective filer, partial CCFS filings. Depending upon the client fee payable, he is thinking. We'll just go with the filing of AOC 4 only. Some may miss MGT 7. Maybe intentionally or unintentionally. For example, which we have shown. For 2021, AOC 4 was filed, MGT 7 was not filed. Then what happens after 15 July 2027? After this CCFS window closes, ROC issue notices for a missed MGT 7. CCFS immunity does not apply. Immunity is per firm, not per company. Full additional fees plus 92.5 penalty on company and each officer. No CCFS protection also. So what CCF benefit requires? Complete filing of all relevant forms. Prepare checklist per client per year. One missed form, full exposure. This is the case. This is one more thing. GST Act 2, trying STK 2. Say company not operational for 3 years. Promoter wants STK 2 under CCFS. GST registration is still active. Please apply for GST cancellation. But for applying GST cancellation or receiving almost 2 months time it will take for filing the GST final order also, final return, GSTR 10 I guess. GSTR 10 is to be filed for almost 2 months will be taken, and if the clients comes in the month of July, we cannot go for STK2 without GST registration getting cancelled. The bank account open with 12,000 balance, the close the bank account and get closure certificate, because this is a mandatory attachment for filing STK2. Any TDS demand outstanding, the pay TDS dues are obtained clearance certificate from the TDS department that there are no dues, but before filing STK2. Start STK2 eligibility check 6 to 8 weeks before window closes. CCFS gives a fee discount. It does not waive preconditions. That is what we have say. This is all, almost everything is from books only, but I just don't know. It will say CCFS needs to be checked before 6 to 8 weeks. But how many of our clients will come 6 to 8 weeks before? Every one of us will be coming in the last day. Anna, file, choda, no problem. So that is the thing. If a client comes, yeah, please. I am unable to hear.
See, the company wants to go under STK2. There are loans taken from directors.
Okay.
And,
Yeah, continue.
and if you want to write back the loans, there could be some tax implications.
Whether it's actual loans or
Is it
Sir is
eligible?
telling practical solution. That is what I said. Is it real loan or book loan only?
No, it's a real loan.
If it is real loan, Sir is telling you a practical solution that it should be written off through reserves and surplus. A capital reserve only. That's what I am saying. Capital reserve, it should be written off through capital reserve. That is a practical solution. To file before STK2, your balance sheet should be 0. Only capital, this much, and reserves and surplus. This much it should be there. Every asset and liability should be 0 only. Only then STK2 will be filed. You can say, sir, STK2 is filing. We have paid the 10,000 fees also. We can pay the 10,000 fee. But once after STK2 is filed, we may get a resubmission notice saying that these the financial statements as per STK 8 format, it is not there. So please give STK 8 format. This is the thing. Can I proceed? Hope your doubt is clarified. $228. Okay. Under income tax, okay. Can I proceed? Yeah. Moving forward. With respect to next thing, the UDIN. We have almost discussed why UDIN has been going to discuss in the CCFS section. UDIN is just a digital proof of when you sign under CCFS pressure. The integrity of the timestamp is at the highest risk. Discipline meets UDIN deadline. The deadline pressure, volume search, client pressure, multi-year backlog. Hope everyone of you are almost aware why we are discussing UDIN in the CCFS section. This is the thing, the deadline pressure. Just because of the deadline pressure, we may just skip our UDIN guidelines, which will be attracted with our disciplinary actions. CCFS creates the perfect condition for UDIN violation. This section shows you exactly how to avoid them. This section shows you exactly how to avoid them. These kind of amnesty schemes or CCFS schemes, they will save the client from paying the much filing fees. But our violation, UDIN violation also for such kind of schemes also will be coming. This is one more thing. Most of us will be knowing already. Section 141 3G of Companies Act 2013, wherein a cap was given. For taxoids, how much is the cap? It's already here. 60 per partner. Earlier, there were multiple scenarios. we used to sign only one partner. All the 300 audits will be signed by the same partner, but it has been removed. Only it was saying 60 per partner. But company statute right, it is 20 per partner only. As per 141 3G of the Companies Act is 20 per partner. Bank branch audits, there is certain limit. LLP audits as per LLP Act. This thing was given, but though there was no prescribed cap for LLP, it is being governed by the LLP provisions. In that 20, which 143(1)G has been discussed, private companies, public companies, listed companies, any company not excluded in the list were already included in this 20. But what are not counted? OPCs are not counted, dormant companies are not counted, small companies are not counted, private companies with a capital of less than 100 crores are also not counted in this 20 cap. So that before making this urine generation or before signing, we need to check whether we are falling in this urine count or not. In here only I am just showing you one tool which we prepared by our office. I will just show you the tool. Is this the app? Yeah, this is the app which were designed by our office, which we are saying you. Just using basic AI only, which we have designed, just by entering only basic forms only. Yesterday night only I told you, so only basic forms were designed by my staff. Where AOC, for example, if I say average capital is around 10 crores. The due date is say example 29th October 2024, and the filing date is suppose we are filing today. By simple Excel only we can just say, but it will save a lot of time. We can just say the format 2026. Just say without CCFS we need to pay 59,100. Under CCFS we are paying 6,450. The entire savings was 52,000. The total percentage of saving is 89. Sir, you told 90% is the saving. Why only 89%? Sir, 90% normal filing fees plus 90% of additional filing fees. So normal filing fees plus 6,000 5,900, around 6,450 we are going to pay. So this is the amount. If you are ready with this amount, then proceed for filing. This is a simple tool. When the client comes at the flag end, we can just throw this tool and say, sir, this is the amount which you are going to pay. Multi-year backlogging, we can just say. Reverse charge under? Which thing? RCM, that is a separate subject. Yeah. If we just enter number of days, this is the total saving. If you say, okay, sir, under CCFS 10 clients, backlog years is 4 years. Simple tool. Then we need to generate 40. Audit capacity, dormant advisor. This is all the basic tool which we have prepared with respect to CCFS, and just as you have seen, just in a fraction of second only, we are able to tell the client this is the payment which you need to done. Yeah, this is the thing which we have simple tool, so that it will save a lot of time. Our staff used to do for a company for almost as madam has said, for almost 5 years one company is not filing. So how much is he will come on the last day, he will ask us how much is the amount we need to pay. Whether he will pay or not, we just don't know. But he will say how much is the amount to pay. Our staff will sit, we will find out each Excel, because we will just see until due date, we will just make 15 more days, so that again we need not do entire calculation, right. So our staff used to sit for 15 more days. From 2019, how much is the fee needs to be paid. From 2020, what is the due date and what is the date of filing. The difference, AOC for how much, ADT1 how much, MGT for 7 how much. For this thing, we have prepared this tool so that easily we can do. Moving forward, we discussed urine rules, generation timing. We have discussed generate urine on actual date of the document signed in. But many, without knowing also, they are generating urine with report signed last week, not permissible. So, there are, due to paucity of time, I am just skipping certain matter of the slide and even certain slides also which we already discussed. The workflow of the CCFS: determine audit requirement per year, verify audit ceiling, complete documentation, signed reports year-wise, generate urine on the same day and file AOC for. Professional controls: we need to maintain a urine control register, certain kind of fields. With this also we can prepare a dashboard also. CCFS audit tracking sheet, this Excel workings, and we can create even a simple dashboard just by clicking once on the column also we can get the output. Before filing, these are the master checklist 1 to 10. I will just share you the PPT, you can just go through, which we already discussed. The CA risk map, wrong form selection, MGT 7, urine issues, incomplete filing, opinion or clean opinion, AGM exposure, STK 2 premature filing, no written communication, LLP client confusion. Post scheme, which I have told you in the MCS circle itself, there is a clear warning. ROC will take necessary action against companies that do not have availed CCFS and are in default. So, we need to avail this CCFS to the utmost this thing. Which are next one, the latest amendments. I will just go through the amendments quickly. Only these three things: decriminalization, the three pillars of the Companies Act reform, decriminalization, digitalization, deterrence via governance. These are the three pillars. Decriminalization from we will discuss in the coming slide. What is decriminalization? Criminal to civil penalty. The court based to adjudication by ROC. Long and the strong. Earlier we need to see, as it is criminal proceedings, we don't know when the outcome will come and how the outcome will be coming. It was uncertain, now the outcome is predictable. Small company, the same we have discussed, 50 until 2020 it was 50 lakhs, 4 crores, now it is 10 crores. As of now, I will just discuss next in 2-3 slides what is the proposed amendment as well. Excluded from small companies, public companies, holding companies, subsidiary company, Section 8 company, companies governed by special acts. DR3 KYC triennial, this is already in force and many of us are already experiencing. Every year we need to file DR3 KYC for all the DIN numbers. Now for once in 3 years only we need to file. This is a good thing only, but we need to remember after 3 years when we need to file. Otherwise, if not filed, penalty comes. Penalty is also not small amount, not 100 or 1000 rupees, it is already 5000. So client will say, sir, we are not all that much amount. We cannot also ask because they are also not paying our fees. How will we ask that penalty? The NEFRA amendment. NEFRA composition include from effective 13 January, MCA, CAG, RBI, SEBI. These 4 bodies nominees also composite to NEFRA committee. Regulation is relaxed, but accuracy must be stricter. Maintain internal KYC tracker regardless of triennial cycle. Section 403, rupees 100 per day unlimited additional fee becomes effective from 7th May. Already we are, for this only we are discussing till now the CCFS amnesty scheme. The corporate law amendments in these 6 brackets which we are simply discussing. What decriminalization, all the entire 117 sections has been amended which we are discussing. In 117 sections, under Companies Act 1 or 2 sections were amended, under LLP 15 sections were amended. These 6 brackets, simply these 6 brackets, decriminalization, ease of doing business, small company relief, regulatory and governance, IFSC or global competitiveness, new concepts. These 6 brackets, the entire amended sections are already fit into these 6 brackets. You can just see 285 which we have discussed, the 10 crore limit in the proposed bill, it has been enhanced to 20 crore, the paid up capital ceiling, and the turnover ceiling from 100 crores to 200 crores it is given. So the benefit has become even wider. This is 285 is one important amendment. Only we'll just discuss only few sections where few amendments have been done, few important sections. Section 171B, earlier till day, not earlier till day, it is mandatory professional certification. Either CA or CS or CMA or advocate should be compulsory certifying. In the proposed amendment, required only professional is engaged. Director declaration is sufficient. This is if we can treat it as a challenging, I will treat it as an opportunity rather than this setback, because I am just not, I am just getting away from the liability. Now I need not make the signature, because anyways we are going to incorporate the company, we are going to make the filings. Just we are not signing on the incorporation document, so that we will just say that it's our not liability. This is one important amendment to even chartered accounts as well. Section 77 with respect to charges, until till day it was 120 days, the extended filing fees up to 120 days. Beyond 120 days we need to go to court proceedings. Now the 120 days has been extended to 180 days. Section 96 AGM, earlier until today it was compulsorily, permanently it should be manual or physical come virtual, both hybrid model. Now in future, in proposed changes, permanent hybrid model has been done, and physical AGM need to be conducted only once in 3 years. Section 99 penalty, madam, this is the 99 penalty. Earlier the penalty amount is 1 lakh plus daily counting. Now the 1 lakh has been capped. This is the proposal. 68 buyback also shares. Earlier it was only 1 buyback allowed, now 2 buybacks are permitted. The gap should not be more than 1 year earlier. Now it has been reduced to 6 months. Section 135, the thresholds also, the net profit threshold, it has been increased from 5 to 10 crores. The CSR committee, earlier it was below, if it is the CSR spend needs to be within 50 lakhs. CSR committee is mandatory, now it is up to 1 crores. Unspent CSR should be transferred within 30 days of the financial year. Now it has been proposed to 90 days. The 144, this is a new thing. I think many of us will be interested in this thing. Non-audit services, only during audit tenure where our auditor is appointed, we should not conduct any other audit services. Now the proposed change is during audit tenure plus 3 more years post tenure also, we should not accept any non-audit service of the particular auditee. That is the new proposal. What exactly this is? A partner rotating out of a listed company in April 2026 cannot provide non-audit service as tax advisory or any valuation or any due diligence to that company until April 2029. This is a setback to a chartered accountant mainly, but we as a chartered accountants, we are trained to read in between the lines. So we know how to escape from these provisions also. Section 149 with respect to independent director, the cooling off period is earlier it was last 3 financial years. Now last 3 financial years plus current financial year also, the independent director test has been tightened now. The company only, earlier it was company only, now entire group, if it is holding company or subsidiary or associate, everything will be under one roof with respect to 149. 164 director disqualification, a non-filing trigger, which I told you. Now it is 3 years, until now it is 3 years. If you don't file any company return until 3 years, your company will be automatically struck off. Now the 3 years has been reduced to 2 years. If you don't file within 2 years, you will be struck off. Additional trigger was given. Apart from non-filing, related party transactions also a trigger was added. What exactly is this means? Sir, we don't have any business, but your bank has certain transactions. Even certain transactions also will be coming under significant transaction, and significant transaction test has been passed. Without this significant transaction test, 164 disqualification of director can be coming into force. 167 vacation of office. Earlier it was limited or interpretational. Now every company will be vacated. Immediately, as and when violation happens, you need to vacate. Now, until 6 months, you are being relaxed. Until 6 months, you can be in the chair. 184, sir was saying, every year needs to be done with respect to filings. Now, only when there is a change in disclosed interest, we need to proceed for filing. This is the thing which we have discussed, the recovery proceedings, the new section 454B, where the Companies Act has borrowed the provisions from income tax, where the person fails to pay the penalty, recovery officer issues a recovery certificate and enforces using income tax act equivalent powers. As of now, this bill is with respect to in JPC only, Joint Parliamentary Committee only. Maybe in coming by the end of December, I think you will be coming. You will be expecting these sections. 454C. B is recovery proceedings. C is a settlement mechanism. I mean, just by sitting, we can just settle these things. In the act, they have given kind of this thing is there in income tax also. It was called as Vivad se Viswas. But Vivad se Viswas scheme, once an order is received, we can go for settlement. But before the order only, we can just go and settle before the ROC and RD and close the issue with respect to 454C. 454D, earlier in GST, till now it was in GST only. Only by paying 10%, you should go for appeal. But in ROC also, the MCA also, the 10% provision has been enacted now. The 454C, D, B, which we have discussed now. The LLP amendment, apart from that, our total amendments, 15 amendments are with respect to LLP also. Certain important amendments has been tabularized. We can just go through 233A, 57A with respect to conversion of trust to LLP, 68B appeal procedure, the new schedule, the framework, procedural framework. We have said that it can be converted, but how it can be converted? It was described in 5th schedule. Section 11, 13, 15, how the faster incorporation can be done with respect to LLP also, it has been discussed. I have just given a summary of the clans, you can just go through later. This is one more V3 interesting amendment, INC 22, INC 23, INC 24, INC 4 with respect to office name or changes. All these forms are going to be consolidated into one form, ECHNG. Company conversions, INC 6, INC 12, INC 18, E-Con. CSR reporting is already into Act. AOC 4, now CSR 2 is an integral part of AOC 4. So, these are the two new forms which are going to be introduced, ECHNG and Econ, which we have discussed. AI based scrutiny is going to be the future. Automatically, your mismatch algorithm is being picked up, where automatically these notices will be coming. I will just wind off my session by just discussing certain few questions, interesting practical questions. Sir, listed companies with AOC 4 backlog, can they use CCFS? Yes, they can use CCFS, but STK2 they can go do, they can't. If CCS is filed after adjudication order, then penalty automatically disappear? No, penalty won't be disappear, which we have discussed. What are we discussed? I am just skipping. Just 2 more minutes. It's no problem, just 2 more minutes. MCA portal, because these are all important practical these things. Because entire section anyone can be discussing. If you just entire keep the Companies Act amendments or CCFS scheme in the chat GPT or Claude, it will only give summary beautifully than this. But we should know the practical intricacies. MCA portal shows SRN as pending for approval. Does CCFS benefit still apply? Yes. Though it is pending for approval, the SRN has been generated. So, still CCFS is applicable. If I sign an audit report on reconstructed books and NEFRA picks up, what is my exposure under proposed and NEFRA sections? The NEFRA composition now includes MCA, CAG, RBA and SEBI, which we have discussed earlier. A listed company audit signed under CCFS is potentially under 4 regulatory scrutiny. This is what which we have discussed, which is the new concept. Can a company use CCFS filing and then MCS1 for dormancy? Yes, if you are going to file MCS1, then use CCFS to clear all your backlogs, then go for MSC1. If a recovery officer attached property under 454B, can a nominee director personal assets be targeted? Yes. 454B, which the provisions were borrowed from income tax, where the the demand proceedings are there, it can go against the company. And the nominee director also will be given a demand order for which his personal assets will be charged with respect to 454B. This is most important provisions. Many of us will be just adding a director for taking any unsecured loan, for taking any loan. So directors are liable for getting these provisions also. Director disqualification trigger, which I said 2 years, is it retrospective? No. Nominee director on 6 portfolio companies, 1 company default 2 years. Disqualified across all 6? Yes, he is disqualified across all the 6 companies. Independent directors approved accounts in good faith. Are they personally exposed to recovery? Yes, independent directors approved in good faith, but they should prove before that we just don't know anything. I mean, we have taken sufficient steps. We didn't sign without taking any sufficient steps. Unless and until independent director he proves himself, he is also liable. He is objected. Audit partner, we have discussed, audit partner rotated out April 2026. Venkat partner provide non-audit service until 2029. He can't do any non-audit service with respect to that client 144 restriction. Company in CIRP means insolvency proceedings. Can the resolution professional use CCFS? Once insolvency professional or a resolution professional is being appointed, he is the utmost authority. So he can do anything in the advantage of the company. He can proceed with his CCFS filings. But can the company go with STK to CIRP companies? Completely unavailable during CIRP. NCLT controls the company's fate. Cost system mismatch, which we have discussed. AOC for 55 crores, 3B 72 crores, flagged mismatch of 17 crores. The CA risk matrix, filing fee exposure, client, adjudication, client plus officers, UDIN, CA. Clean up. Till now what we have discussed, this is the entire risk matrix of a chartered accountant which you are going to face. Clean opinion, if you are going to clean opinion, be ready for NEFRA notices. Non-audit services, post-rotation, these are the things. Recovery, cross data, corporate loss, amendment. Simply, we have just discussed everything. Now, these many amendments we have discussed. This what? With respect to amendments also, we have designed a tool wherein we will just introduce the section number and for example, what is the section 2, the old section and the new amendment, the proposed amendment. These are very, very simple tools. The old existing provision and the amended provision. So everyone, when a client comes, so we can just go through these things also. So these are all procedural notifications which we can go through. Conclusion. This is all. CCFS is a genuine one-time opportunity and a practical, critical advisory moment for every chartered accountant. Used correctly, protects client from massive additional fees, restores compliance standing, closes years of default. Used carelessly, without AGM exposure check, without proper audit procedure, without valid evidence, create professional risks that exceed the financial benefits. Amendment signal. Compliance is simplifying procedurally, but accountability is intensifying substantially. The window closes 15th July 2026. So let's act fast. Thank you. Thanks for giving me this opportunity. Thank you for did I make my presentation bore? Thank you. If you get any doubts, apart from this forum, we'll just discuss outside also. Thank you. Thanks for the opportunity.
Thank you very much, sir. Thank you very much, sir. One important takeaway from this session is that keeping pace with regulatory amendments and adoption of new technology is no longer optional. It is essential for delivering quality professional service. The practical examples, technological insights, and regulatory updates shared today was certainly enhanced our understanding. On behalf of SIRC and all participants, I sincerely thank you, sir, for an insightful session. We can now break for a tea for 15 minutes. Please be back within 15 minutes. Thank you. Welcome back. May I request Sir Ashwath Subramaniam, sir, on dice, please. We are pleased to welcome Mr. Ashwath Subramaniam, a chartered accountant with over 6 years of post-qualification experience. He holds a diploma in International Financial Reporting Standards from ACCA UK, a certificate in Investment Planning and Wealth Management CSR and FEMA from ICI. Along with the degrees in Commerce and Law, he is also pursuing a valuation course. His expertise spans in international taxation, transfer pricing, gap convergence, and regulatory engagements. Over the years, he has led statutory audit, GST audit, and provided CFO service to NBFC and technology startups. His industry exposure covers financial service, IT, hospitality, manufacturing, and more. Beyond his professional achievement, he is also a trained pianist from AR Rahman Music Institute. We are honored to have him with us today. Thank you. May I now request Guru Sekaran sir to kindly present memento as token of appreciation. So hope everyone is power packed up and ready for the next technical session. So over to you, sir.
Thank you, Shweta. Good afternoon, everyone. So I know it's past 12. I'm sure that all of you've just had your tea break, but I'm quite sure your stomach would already be tingling for some lunch. I will try to keep this session as informative and as interactive as possible. So I'm not choosing some topic today which is too technical or too regulatory per se. This is a more of a type of an offbeat topic which I have chosen because I would also like to probably share my experiences. I've been in practice since 2018 and over the years I have felt that this is something which has become a more lucrative form of a consultancy for us chartered accountants. So I thought I could just share my experience on this particular topic. Most of it is something that each and every one of you would probably know. I see a lot of veterans in the audience today. So the objective of the session here that I am planning to take is more of just consolidating multiple areas of our practice into one bucket, which helps in bringing capital into a company. So we will be discussing the legal structures, compliances, the regulatory considerations that we will have to ensure when an entity brings in capital or when a promoter wants to raise capital. Because today there are a lot of entities, whether they are startups or SMEs or large entities, bringing in capital has become one of the most important areas that a finance professional has to take care. And today's session is probably very special for me because amongst the audience, my mother is also sitting here and she is listening to this. So let's go ahead. So, so the next 2 hours roughly, I will be setting the tone, setting the stage for this entire presentation. And then we will be going through what are the legal structures, what is the compliance with respect to ROC, what do we have to consider with respect to valuation? What are the regulatory overlays involved in bringing in capital? And I just have a couple of simple case studies that we could probably discuss so that we can cover multiple grounds. And like I said earlier, what I intend to discuss in this session is intended to probably make all of us just go out, and the next time we meet a client, this is going to really help us fetch some really good business in terms of a consulting advisory. And apart from ROC or the FEMA or SEBI related guidelines, we will also be discussing about income tax. And as you all know, Income Tax Act has changed from 1st of April 2026. So until transactions pertaining to financial year 25-26, you will have to consider the provisions and rules and regulations as per the Income Tax Act 1961, and thereafter you would have to consider the Income Tax Act 2025. Although the law has substantially not changed in its core, but nevertheless the intricacies would still have to be evaluated before arriving at a judgment. Okay, so before we move ahead, let's just go at a very simple question. Why do companies raise capital? If anyone in the audience can just thinking out loud, why will companies raise capital? Why do they need the capital? Anybody? Sorry? Correct. So working capital is one. Machinery. PP&E. Yeah. So business expansion. So basically purchase of plant and equipment. Yeah. Sorry. M&As. Yeah. Perfect. I think that is one of the most important areas why large entities are raising capital today, because they want to acquire businesses altogether. So more or less you have covered whatever we were about to discuss. So primary reasons that you can identify as to why a business would want to raise capital is for expansion. They would want to purchase PP, like sir said, to expand their capacity, probably move into new geographies, start manufacturing new product lines or product verticals. M&A is one, to acquire new businesses altogether, buy out the competition, either a vertical acquisition or a horizontal acquisition. For the working capital, funding your day-to-day operations, that itself is quite a big challenge for several entities. The other ways to look at is debt refinancing. So a company might probably want to basically replace an expensive debt. Let's say, for example, they are currently getting a working capital loan from a bank. Probably it would be at a rate of say maybe 11% or 11.75%. But there may be an alternative to go for a non-convertible debenture or an optionally convertible debenture, which you could probably get at maybe about 10%, depending on the rating of the company, depending on their credit worthiness, etc. So debt refinancing is one way or is one probable reason as to why a company would want to raise capital. Regulatory requirements may also be a requirement. For example, NBFCs are required to maintain the minimum net worth, that net owned fund requirement is there as per RBI requirements. So to maintain that also, probably companies would want to raise capital. The last part, usually this happens in IPOs, but nevertheless even in private equity investments also this happens. An offer for sale. Founders basically would want to use this route as a means of getting money and exiting out of their business. So probably it may happen before an IPO, or like for example, I think Boat recently before their DRHP papers were approved by SEBI, the founders had actually progressively sold off their stake in the company. And this is usually used as a means and ways by which the promoters can take some cash back from their business, having spent enough time trying to build it. Right. So now what is the governing framework for raising capital? Now, there are several laws that may be applicable depending on the type of business, but we are going to restrict our discussion only to the bare minimum 5 basic pillars or core pillars of the governing framework, which would be obviously Companies Act. Whenever the company raises fund, Companies Act provisions are required to be borne in mind. Now, some of the provisions that govern this particular thing from the Companies Act would probably be section 42, section 62, section 71. 42 talks about private placement, 62 talks about further issue of capital or ESOPs, preferential allotment, 71 talks about debentures, and then you have deposits. 73 to 76A of the Companies Act talks about deposits. 186 talks about intercorporate loans and investments, and then you have FEMA. Now, if there is a foreign investment coming into the company, be it FDI or FPI, whether it is in the form of debt or equity, you have FEMA related compliances that you have to keep in mind. So, for example, if a company, if a foreign investor is planning to invest 10% or more of the capital into a company, then FDI regulations are applicable. You would have to file FCGPRS forms. All these requirements are there. Then you have SEBI regulations. SEBI regulations would predominantly involve for listed companies or companies which are planning to get listed on the stock exchange. You have the ICDR regulations, the insider trading regulations, SAST takeover regulations. These regulations are required to be borne in mind while raising capital, particularly for listed companies. Next is your Income Tax Act. Whether it is the 1961 Act or the 2025 Act, you would have to consider income tax related compliances. For example, in the erstwhile Income Tax Act, you had section 50 CA, which talked about selling of shares at unquoted listed shares. So, you had to do it at a fair market value, which required a valuation methodology as per Rule 11 UA and things like that. Now, this particular thing will still continue in the Income Tax Act 2025. It has not changed much. And what was there in the Income Tax Act 1961 was the angel tax under 5627B, which was however abolished in the Finance Act 2024, and subsequently I don't think it's also been brought into the Income Tax Act 2025. And the last important thing that has to be considered is also the DPIIT framework for startups. So, there are a lot of startups that keep coming up, right? You have the IIT Research Park Incubation Cell, where there are, I think as of today, I think there are some 550 startups which have been incubated at IIT. So, the Department for Promotion of Industry and Internal Trade also issues certain notifications or circulars, particularly for startups, which also have to be considered before you raise capital. Now, we cannot, in our session for today, we will not be discussing about the DPIIT regulations, because they keep changing from time to time and would probably be applicable to maybe a select case of startups, because as and when startups go into incubation centers, they have a different set of rules and regulations that they have to follow as per the incubation cell of the incubation cell. So, we are not getting into the DPIIT part today. However, we will be touching upon the remaining regulatory compliances. Now, what are the legal structures for bringing in capital? You have, as per the Companies Act, you have a rights issue, you have private placement, ESOP and preferential allotment. Now, what is a rights issue? A rights issue is basically where you are giving an option to the existing shareholders to purchase their shares, purchase the shares of the company, right? So, you don't want to disturb the existing shareholding pattern. You would rather want the same people to subscribe to the shares of the company. You don't want someone external coming into the ownership pattern, right? So for this, some of the important criteria is that you are going to offer it at a pro rata basis based on their existing shareholding pattern. You have to give them a notice of, you need to give them minimum 15 days to make their decision as to whether they want to, proceed with the, subscription. And those who don't want to subscribe to the shares, they need to be allowed to renounce their rights to any other person. And this can be used as a very good planning tool that, for example, if some particular individual or the organization needs to, come into the shareholding of a particular company, then rights can be issued and the rights can be renounced such that that particular organization or individual can become a shareholder. This is usually used for very closely held organizations if the valuation should not be impacted, and if they have a preference of a particular investor but they are not able to, for some reason they are not able to go for a private placement. And an ordinary board resolution is required for a rights issue. Okay. The next is a private placement. Now for a private placement, you are allowed to do a private placement of shares to a list of specified people, only up to 200 people per class per year. So let's say as a company, I have equity shares and I also have a class of preference shares. I want to do a rights issue. I can do a rights issue for the class of equity shares, and I can give the I can do a private placement of equity shares to 200 persons. I can also do a private placement of the same class of preference shares for 200 persons, and this will apply for one full financial year. So once I have done a private placement for 200 people, in that year I cannot do it again for that particular class of share. The limit resets every 1st of April, and we will have to make the allotment within 60 days of receipt of the funds, and for this we will have to issue the offer letter in form PAS 4, and the company must also maintain the list of the identified persons to whom the shares or the instruments intend to be placed with. That is, I think, form PAS 5. So the 200% rule is a very, very important threshold with respect to private placements. What happens if I allot more than 200? It is deemed to be a public offer, and then SEBI starts kicking in. Now, what is important here is also that you should maintain a separate bank account. Let's say for operational purposes, we have one bank account, we have passed a board resolution, and we have placed the shares. We have identified the people to whom the shares need to be issued, and the potential investors have given the money to us. Now, the thing is, we cannot take it in a regular operating account. It has to be in a separate account, and preferably it needs to be for every class of private placement. Now, so the offer letter needs to be issued exactly in form PAS 4. Emails and WhatsApp messages, though they are used as a very, very convenient form of business communication and correspondence, cannot be said that it will comply with the requirements of the Companies Act. It has to be in form PAS 4, the offer letters. Okay. Next is ESOPs. Now ESOPs are a very in some sense for some entities it creates a bit of a controversy, but it's also a very good way of planning your capital structure. because you are issuing ESOPs or sweat equities to your own employees, and this becomes a way of retaining your talent. It is also a way of attracting talent. Now, what happens is ESOPs, as you would all know, that they are given based on some criteria and to a certain set of employees based on performance obligations and things like that. The ESOPs will vest over a period, and after that vesting period, the employees are allowed to exercise the options at the price at that point of time. So now what is all required with respect to ESOPs? A special resolution is required in the general meeting for the ESOP scheme. You should circulate the ESOP scheme to your employees. It is very, very important. There are some companies that have passed the ESOP scheme. They have also considered it in the payroll as part of the company's, as part of the employee's CTC. They have forgotten to communicate the ESOP scheme altogether to certain employees. When the employee is receiving the pay slip at the end of the month, he was surprised to know about the ESOP scheme. So this is the communication to the employee is a very, very, very critical part with respect to ESOPs. And in case of a listed company, the nomination and remuneration committee would also have to approve the ESOP scheme. Now, for ESOPs, there, as I had already mentioned, you have a lock-in applicable. You will have to allow that vesting. Once it vests based on the conditions as per that scheme, the employee has an option to exercise the stock options. Now, ESOPs as by itself is a separate topic for discussion. For example, ESOPs can be cash settled or equity settled. So, probably that is something we will have to look at separately, and if you need any assistance on that, maybe we can discuss offline separately. At the end of the presentation, I have given my contacts. We can always have a valid discussion on ESOPs separately. Now, one thing which is probably important in ESOPs is the tax treatment. So, at grant of ESOP, there is no tax. During vesting, there is no tax. At the time of exercise, it is taxed as a perquisite for the employee. At what value? FMV minus whatever is the exercise price into the number of shares. Now, here with respect to DPIIT recognized startups, there is an option to defer the tax treatment. So, this is the benefit that the DPIIT recognition offers for certain startups. Now, the once the shares have been subscribed or once the option has been exercised, when the employee sells the shares, it results in a long-term or a short-term capital gain depending on the period of holding. Now, the period of holding you will have to calculate from the date on which the exercise has happened, not from the date of granting the option. Okay. So, apart from ESOPs, there are some MNCs, multinationals, who offer stock units, RSUs or PSUs, they call it like that, restricted stock units or performance stock units. These are not stock options, they are basically the stock units of the parent organization. Let's say, for example, you have a company, let's say Walmart is situated out of US, it's headquartered in US. It has an operation in India, and employees are working in Walmart India. They, as part of the pay package, they are also given a chance to subscribe to the stock units, the RSUs of Walmart Inc. So, now in this case, there is no option to subscribe or option to exercise. It is directly allotment of the shares of the Walmart Inc. So, in this case, again the perquisite taxation will come in at the time of vesting, because there is no concept of an exercise. It directly vests, and upon vesting they become owners of that particular asset, and at the time of vesting the employees are taxed as it is taxed as a perquisite, and when they sell it they have a long term or a short term capital gain depending on the period of holding. The next form of an equity instrument covered in the Companies Act is a preferential allotment. Now, rights issue is given to the existing shareholders. Private placement is for a specified set of individuals or organizations. ESOPs is to your own employees. Then what is preferential allotment? Let's say I am running a business. It is around say 200 crores in turnover. Whatever is the nature of business. I need an investment. I go and I find an angel network of investors, or I have identified a venture capital fund which is willing to invest in my company. I will use preferential allotment as the way by which I can issue the shares and raise funds for my company. For this, a special resolution is required. Ordinary resolution is absolutely insufficient. You need a valuation report from a registered valuer who is subscribed to the category of SFA, Securities and Financial Assets. In case of listed entities, SEBI related pricing norms are required to be borne in mind. So basically, SEBI related pricing is based on the volume weighted average price of a 90-day or a 10-day trading period. And in case of listed entities, the lock-in period for a preferential allotment will also be applicable based on the regulations. Now, we have seen what are the methods by which we can issue equity instruments. What are the equity instruments? That is mentioned in section 43 and 55. Equity shares and preference shares. I mean, this is a very, very basic concept that all of us know, but nevertheless, let us just go through it once. Equity shares represents the ultimate ownership of the entity, of the company. If the company has gone bankrupt and if it has been sent into liquidation, then you are going to be the last person who is going to get money, if at all anything will be there. Voting rights, normally one share will give you one vote, but you have something called as differential voting rights. Now, normally companies where the promoter wants to retain the control but still wants to expand will prefer to go for DVRs, because there you would be issuing shares with superior rights and inferior rights. They call it SR and IR. Now, those with superior rights, probably one share would give them 2 or 10 votes. Something like that. But again, the power to issue DVRs needs to be enabled in the articles of association of the company. And equity shares will fetch you dividend. It is not guaranteed. Only if the company has a profit, subject to compliance of section 123 and the from 123 to 127 of the Companies Act, subject to compliance of those legal aspects. If you are eligible, you will get dividend. Now, because you are taking the risk as an equity shareholder, the rewards are absolutely so high. There is a return upside, but there is also an upside in your risk. And we have discussed about DVRs. Now, preference shares. Preference shares, they are given priority in dividend, and at the time of liquidation, they are given priority towards repayment of capital. They have no voting rights. Usually, they have no voting rights. They have a fixed dividend rate, and if the company cannot pay, most of the times people prefer to go for a cumulative preference share, and the dividend accumulates over the period, and maximum it can be issued for 20 years. I think for the infrastructure companies, it can go to 30 years if I remember right. Arrears of dividends are, the preference shareholders are eligible for the arrears of dividends at the time of winding up. And like I said earlier, they have preference over equity shareholders at the time of winding up with respect to their capital. Now, there are convertible instruments. We are jumping the gun a little bit, but it is okay. We have not yet seen debt instruments. We have only seen equity. Debt we will see a little bit later. So, we have convertible instruments. What are convertible instruments? Those instruments, whether equity or debt, we can convert finally into equity. So, you have compulsorily convertible debentures, compulsorily convertible preference shares, optionally convertible debentures, optionally convertible preference shares. Now, usually investors prefer the convertible instruments as a preferred route. Why? Because it gives them a security. If they let's say an investor comes in, gives you the optionally OCDs, optionally convertible debenture. Now, from the investor's perspective, 5 years later, he can decide if he wants, he can just pull out his money and move on. At the end of 5 years, let's assume the term of the debenture is 5 years. Up to 5 years, he will definitely get interest repayment. It's a sure shot return. And at the end of 5 years, if he finds no value in the investment any further, he can decide to just say, I don't want it to be converted. Please repay the debt capital back to me. It's a very simple statement, and the company is obligated to pay back. So, the same case is with preference shares also, right? So, this is a more preferred route for an investor, because there is a security in terms of the capital recovery. Now, compulsorily convertible debentures. So, at the time of the trigger event, okay, the debentures have to be converted into equity shares. So, if it is a compulsorily convertible debenture, there is no option for not converting. You have to definitely convert into equity shares. It is issued under section 71 of the Companies Act. You get a coupon rate. Every year you will get interest, and that interest is a tax deductible expense for the company. And at the end, the debentures are converted into equity. It's a very simple thing. But however, at the time of conversion, you will have to do a valuation of the company to assess what will be the value at which the conversion will happen, to determine how many shares have to be allotted to the debenture holder. Now, if a foreign investment is coming in the form of a CCD, you will have to consider FDI related reporting, because compulsorily convertible debentures are considered as equity investments with respect to FDI. Because they finally become equity, you have to treat them as equity investment as per the FDI regulations. You have to do the FCGPR reporting at the time of issuing the CCDs itself, not at the time of conversion. Same is the case for compulsorily convertible preference shares. The only difference between CCD and CCPS is the dividend that you pay to a preference share will not be tax deductible. It is out of after tax profits. And at the time of liquidation, debenture holder, if it happens before the conversion, the debenture holder will be given superior priority while making in the order of the repayment. So, this is it with respect to compulsorily convertible debenture and preference share. Now, optionally convertible, as the name suggests, it is merely you have an option at the end of the term. The instrument holder can decide as to whether they want to convert into equity or not. And if there is a foreign investment for an optional instrument, then the FEMA views this as a debt and not as an equity, and consequently you will have to cover the ECB framework also. So, for example, I think within 7 days you will have to file the ECB forms with the authorized dealer, and every month you will have a reporting on what is the status and utilization of the respective fund. Okay. Next is debt instrument. Now, we have already seen debenture. The same will come here. If it was convertible, it is a hybrid instrument. If it is non-convertible, it is a debt instrument. So, otherwise the debenture related requirements are the same. For the NCD, it can be secured or unsecured. If it is a unsecured debenture, it is all the more simple. Just have to take the fund and appropriately ensure the repayment. The interest is a tax deductible expense, and for the secured debenture, you create a charge over the assets of the company, just like a loan. Now, what happens with respect to listed companies? You need to appoint a SEBI registered debenture trustee who will take care of the debenture issue, and he will be present right from the time of the issue until the debentures are redeemed. And DRR, debenture redemption reserve, is mandatory for all public issuances. Section 186 covers intercompany deposits or loans. You cannot give loans for more than 60% of the paid up capital plus free reserves plus security premium, or 100% of the free reserves, whichever is higher. You need a board resolution, and you need, if it exceeds the given threshold, you also need a special resolution. In this case, rate of interest cannot be more than the prevailing government yield. And next is deposits from public. Section 73 to 76A of the Companies Act covers deposits. Based on the net worth and turnover criteria, only those eligible companies are allowed to issue deposits. The credit rating for companies is mandatory, and deposits cannot exceed 25% of the paid up capital plus free reserves. The last form of debt instrument that a company can avail is external commercial borrowings. Now, if there is a foreign investor who is willing to give funds to the company, but he will give it as a loan, you have to take it as a external commercial borrowing, ECB, under the RBI framework. You have restricted usage for an ECB. You can use ECB only for there are certain prohibited usages for ECBs, which would be, I think, you can't use it for real estate, you can't use it for tobacco manufacturing, lottery business, chit funds, nidhi companies, or activities which are not technically open to the private sector. So probably things like the defense and all that, you can't give ECBs. FDI has been allowed for the defense, but ECB is not yet allowed. And your rate of interest would be, it is defined that it cannot be more than the prescribed LIBOR rate. And you have, like I had mentioned, you have end use restrictions for the ECBs. You have a minimum average maturity. It has to be at least 3 years. It can't be before that. And you cannot use ECBs for working capital facilitation. It has to be for proper purchase of equipment and business expansion related purposes. Usually ECBs are used by MNCs, where the holding corporation funds its subsidiary in India, or they give the money in the form of an ECB, because it would be it is a tax deductible expense for the subsidiary here, and it would save the interest cost when compared to getting a institutional lending if they had to do it in India with a bank or any other debt service provider. So now a very simple decision matrix. This decision matrix may not hold good in all situations, but mostly if there is a domestic PE or a VC investment, CCPS and CCDs are preferred. If the founder wants to preserve the control but still wants to grow, like I had mentioned earlier, issuing equity shares with differential voting rights or rights issue is a preferred way. If you have a foreign strategic investor, going for the CCPS or an equity investment in FDI route will be preferable. Short-term working capital loans, if you have group entities, prefer the intercorporate loans. You have long-term funding for the business expansion or development, prefer ECBs or NCDs, because NCDs provide you it helps in your cash flow management, because your repayment will be one shot as a bullet repayment, at specified intervals. And for startup funds, CCDs are preferred, but lot of PEs do take the risk in investing in startups. For employee retention, go for ESOPs. Very clear. Now we go to the ROC compliances. We have understood what are the modes by which companies can raise capital, but now primarily because we are talking about companies, we need to completely remember the ROC related compliances first. Then we can go to SEBI related, if it is a listed entity, income tax, all that will form part of a secondary layer of compliance. Now the first thing that we need to do for compliance is pre-allotment. We need to verify the authorized capital. Let's say my authorized capital is 1 crore. I have found an investor who is willing to give me 10 crores. Can I issue capital? No, because my authorized itself is only 1 crore. First, I need to increase the limit of my authorized capital. I have to amend my memorandum. I have to file SH7 to record the increase of authorized share capital. It has to be done within 30 days of passing a special resolution to increase the capital. And because it is also a special resolution, we will also have to file a MGT 14. And because there is an increase in the authorized capital, we have to pay the relevant stamp duty charges also. Next is convene a board meeting. Get an approval for the capital raising proposal. How much are we raising? What is the mode of investment? Because all said and done, the board of directors are the one who are in charge of the governance and monitoring of the company. So they must be well aware as to what is the capital that is going to be raised, how is it going to be used, and then approve this particular matter before you go for the investment or a capital allocation. Now this mode can be, like we had discussed earlier, it can be a rights issue, private placement, preferential allotment. If there is a preferential allotment, PAS 4 has to be approved very specifically, and it must be sent to the list of specified persons. Then convene a general meeting, pass a special resolution for the private placement. For the preferential allotment, you again need a special resolution. For the ESOPs, you need a special resolution. And for debenture issuance, where you are issuing it with certain rights. For example, if you have a debenture trustee involved and things like that, you will obviously also need a special resolution. Special resolution follows a MGT 14 filing. Then that MGT 14 you will have to file within 30 days of passing the resolution. Otherwise, it is going to attract penalties. And I think more than me, the previous speaker would have already informed you the penalties and how the Companies Act is expected to change in terms of the decriminalization of penalties and offences. Now, after you have passed resolutions and filed MGT 14, you have to issue the offer letter. Let's say for the private placement, you have to issue PAS 4 to the concerned allottees. You have to issue it within 30 days. And now PAS 4 should normally contain the name and address of the company, the allottee, or what is the number of shares being offered, what is the issue price, basis for arriving the issue price, terms, conditions, restrictions. These are the things which you will have to issue, these are the things which you will have to place on record when you are issuing the offer letter. Now, apart from this, you will also have to obtain a valuation report. Valuation report has to be from a registered valuer. You need to take it to arrive at what is the value at which you are issuing shares, and to arrive at, based on that value, how many shares are you going to issue to the concerned investor. To derive at those numbers, you will need to obtain a valuation report. So, this is something which we have already discussed, that let's say day 0 is allotment, within 15 days you have PAS 3, Then MGT 14 you have to file within 30 days from passing the resolution. If you are altering your share capital, you have to file SH 7. Then if there is a foreign investment, you also have to consider filing FCGPR. Okay. Now, what are the common things that we may miss out in case of in the pre-allotment stage? If you remember, for private placement, we discussed the maximum number of people to whom the private placement can be done is 200%. If I exceed it, it becomes a deemed public offer. So that applies for one financial year in aggregate for every class of share. We may miss out on counting the number. There are companies which have actually missed or have made errors in making this calculation and have ended up paying penalties for this. The second one, application money. Like I had already mentioned, get the application money in a separate bank account, because if the allotment has not happened, you have to return it within 15 days. Sir, it is not a violation, but problem is it has to be in a separate bank account. But if you do this, the thing is that you always invite ROCs, yeah. It's an unnecessary thing amidst so many other things that you're doing. Because like when I started, I said raising capital is probably one of the most important things happening today. And although we say it very simple that, we are raising funds, the entire process, right from identifying an investor up to allotting those shares or allotting those securities, it is a very, very tiring exercise. And this is just about private placements. We are not talking about IPOs at all. This is all until the IPO. IPO is a totally different topic by itself. So, you have to prepare a prospectus, the DRHP papers have to be filed, the banker and the lawyers have to be in sync. So, yeah, correct. Yeah, due diligence itself is correct, exactly. Correct. So, even up to the pre-IPO stage, raising funds, though it is a simple thing said, in all aspects of operating it, it is a very, very tiring task by itself. So, having such, for the sake of trying to, ease out your work for maybe a day or two, we might end up wasting our time in future if we do all this. So now, yeah. Yes. Correct. Yeah. So the other one is, we may have identified the list of people for the preferential allotment. We would have even approved the offer letters, but we would have forgotten to issue it. That becomes a tricky situation at that time. We would have passed a special resolution, we would have documented it, everything done. We would have missed to file the MGT 14. MGT 14, I think, results in a 100 rupee late fee for every day not filed. Then 186, you have the limit beyond which you are not supposed to issue loans without specific approvals. We may have missed to accord those approvals. FCGPR filing delays are something which will also be a compliance trap that we may miss out. Yes. The penalties are too much to be wondering about at that time. It may sometimes result in, spending your entire capital raised on penalties. So we need to be very careful. It is better that once we are, clear that an investment is coming in, it is better that we prepare a complete checklist before even approaching the investor to get them to start initiating the talks of getting the money. It is better that we, go through that checklist for maybe once or twice before getting into the transaction itself. Now, we have spoken about ROC related aspects. One thing which kept cropping up is valuation. So, a very quick brief on valuation. What are the practical aspects of valuation? Because again, this is a very, very lucrative aspect for us chartered accountants. Companies Act mandates valuation under various sections. Section 247 of the Companies Act actually institutes the registered valuer, and FEMA regulations also require valuations to be done. Income tax also requires certain valuations across various sections of the Income Tax Act, read with the respective rules. So as far as Companies Act related valuations are concerned, it is to be done only by a registered valuer. A chartered accountant per se cannot do a valuation unless he or she holds a registered valuer certificate from an RVO. And for FEMA related valuations, a SEBI registered merchant banker or a chartered accountant can perform the valuation. For income tax, a specified person, now at least under the new income tax regime, under rule 247, they have specified for a particular class of asset as to who can value the asset. And for the valuation of unquoted shares, for example, it can be done by a chartered accountant, cost accountant, or a person who holds a degree or a experience in finance. So these are the places where valuation is predominantly mandated. You may have valuation in various other areas, but we are limiting our scope of discussion to these. What are the methods of valuation? Discounted cash flow is the most commonly adopted form of valuation. We consider the entity to be a going concern. We take 5 to 10 years of cash flow estimates, and we do a more forward looking approach. Consider a discounting factor, probably make adjustments for marketability of the entity or any other control deficiencies, and we arrive at what is their value. So while arriving at a DCF valuation, we also have to consider the sensitivity analysis. For example, a 1% change in the discount rate above or below, to what extent does it affect my entity's valuation, is something which is very, very, very critical, because a change in 1% may, in today's scenario at least, with the changing economic factors, it can blow up or tank a company. So that sensitivity analysis and its study is very, very important. Book value is one way of valuing a company. It's a very simple objective based valuation, simply based on the audited financials of a company, though it is not usually used for the funding. Yes, sir. Nobody does it. Yes, DCF is widely used, but DCF is actually used more for the sake of convincing auditors, if you ask me, because companies are predominantly valued more from the business perspective. They are valued at say an X factor of EBITDA, or PAT is usually not taken, but EBITDA is the usual way by which they value companies. Now ideally the value that is derived of a company based on the times of EBITDA should equate to the DCF value, or at least somewhere ballpark it should come. So valuers reports usually are used to substantiate the value already derived based on the EBITDA. So that is also the times by which they factor the EBITDA is based on how the peers operate in the same industry. And of course 11 UA in income tax is of not too much use now, because angel tax has anyways been abolished. So probably now for valuing unquoted equity shares, we may use the rules prescribed in the income tax rules. Registered valuers under Companies Act, you have 3 asset classes: security and financial assets, land and building, and plant and machinery. The Insolvency Bankruptcy Board is the regulator for registered valuers. You need minimum 3 years of post qualification experience. I am talking about us chartered accountants, and before we become a registered valuers, we have to complete a 50-hour training, and I think after that also for renewal, I think CP is mandated. So usually we chartered accountants enlist ourselves as registered valuers for the securities or financial assets class. So we are usually our services are availed for valuing shares, debentures and derivatives. Now, what are the other aspects of the regulations which apply? FEMA. If there is a foreign investment at play, FEMA will come knocking at our doors. Not knocking, it will come demolishing our walls. So you have FDI and FPI. What is the difference? FDI is basically where a foreign investor comes and invests 10% or more of the capital of the entity. FPI is more of a person who invests up to 10% of the capital. They invest predominantly in indices and stocks. FDI is more for a strategy to get a proper return from an individual entity. FPI are governed by SEBI. So if their investment goes beyond 10% in a company, then they automatically get converted into an FDI. And FDI has a automatic route and a approval route. So approval route is basically for certain sectors for which the government has to approve. There are certain very specific sectors for which the government approval is required. Generally, you most of the FDIs are automatic today because the government has become flexible. Yes, sir. By a FPI by a private limited entity outside India, you are asking. No, sir. Usually FPI, because it is governed by SEBI, usually only the public entities are taking FPI, sir. Because private entities more or less cater to private equity funds or VC funds, which predominantly act more as FDIs and not FPIs. Because they are SEBI registered, only public entities are allowed to operate with FPIs. Sorry? Yeah, so I think Pakistan, Bangladesh, China also, yes. But now I think with China, I think they are thinking about easing out restrictions. Yeah, they have given several exemptions now. Yes. So, but I think Pakistan and Bangladesh are clearly ruled out. They don't have money to invest. That's a different story. Yeah, correct. I mean, when China is investing, yes, in practice, the regulatory approvals take more time. There is a lot of scrutiny involved. For example, you need a prior approval because even very recently, one of our clients, they were getting into a joint venture with a Chinese corporation. So, the approval almost took about a year for them. The prior approval. They are now, because they have gotten the assent, now they are getting into the formalities of incorporation and things like that. Yeah. No, see, you are asking from FEMA perspective. I think FEMA allows a CA to value, sir. You don't need to be a RV. But nowadays, most of the companies are requesting the RV only to value because they are able to use the same report in multiple places. So if we are, let's say we are not a registered valuer and for FEMA purposes the company gets it. Yeah. In practice, though the law allows a CA to yeah. Yes, so pricing guidelines are very important. If you are issuing it to a non-resident, it should not be below the fair market value. If it is being transferred from a non-resident to a resident, it should be meaning it is transferred to a resident, it should be at least at fair market value. If it is again being transferred to a non-resident, the fair market value becomes a very important play. And like sir mentioned, FCGPR, FCTRS. FCGPR applies where you are issuing the instrument for the first time. TRS applies where there is a transfer of the instrument. FCGPR has to be filed within 30 days of allotment. TRS is to be filed within 60 days of the transfer. Now, like I had mentioned earlier, prohibited sectors for foreign investment is usually lottery, gambling, chit funds, real estate, atomic energy, railways. These are, usually the prohibited sectors. Sorry? Yeah, agriculture is also a prohibited sector. So, income tax, the angel tax is anyhow now abolished with Finance Act 2024, and Income Tax Act 25 also does not contain the angel tax. Unexplained cash credits is a very dicey topic with respect to fundraising, because they issue under 210 gift tax.
They also say that money is, if I get a strategic investment, they are still saying they examine under section 6.
Oh, okay.
You have to give that cut out if you have made any. Like Hindu or some newspaper discount, all that you have to.
Oh, okay. This is very peculiar.
Because they examine under section.
Okay. So I think there is one Supreme Court case of PC80 versus NRA Iron and Steel, where the Supreme Court has said that just simply producing the PAN of your investor is really not going to be to the satisfaction of the AO. Instead, you need to prove the creditworthiness. What KYC have you done at the time of getting the investment? How clear are you that this is not any unaccounted money which is being routed through in the form of a capital? All these things need to be presented before the AO to prove that this is not an unexplained cash credit. Now, on unlisted shares or even listed shares, the capital gains will come whenever it is being transferred by the respective shareholder. And of course, the ESOP perquisite tax will anyhow continue even in the new law. It will be taxed at the time of exercise. SEBI will apply whenever there is a public issue. ICDR regulations, the lock-in periods as per the regulations, the promoter group holding, all of those rules and regulations will kick in for any listed company or companies which are going for listing, which have applied for the DRHP papers and are in the process of getting listed. The preferential allotment pricing is a 2-week or a 26-week volume based weighted average pricing formula. So basically it is a sum of the volume into price divided by volume. And insider trading blackout windows will apply whenever there is a relevant case that is going on. Takeover code will also be triggered wherever necessary if there is a 25% or a 5% creep in of a investor. The disclosure obligations with respect to price sensitive information is very, very stringent in the case of public entities. In the case of unlisted companies, SEBI will start coming in if for the private placement you go more than 200 allottees. It becomes a deemed public offer. If you are going for a pre-IPO placement, today this has become a very, very it has become a big fashion today that pre-IPO all the unlisted companies do a placement of shares and they get the fund, and after just about 1 year before the IPO they do this. They go for IPO and then all these shares are offered for sale so that the investor gets a return. For that company, actually it becomes a working capital cash flow more than anything else. And if there are any QIBs, qualified institutional buyers, who are coming into the play, they will have to adhere to the SEBI framework. For the listed entities, the SEBI share-based employee benefits regulations will also kick in.
Can you explain that PIPO placement for unlisted
Yeah.
PIPO placement?
Yeah, so I'll be very brief. So, see, what companies are doing today is they are basically, maybe a year or year and a half, 18 months maximum before they go for IPO or they intend to go for IPO, they issue shares. They call it itself as a pre-IPO allotment. Okay. So, what they do is the valuation is at par with an IPO valuation, and they issue the shares so that they can take care of their temporary funding, and this basically builds up their balance sheet up to the IPO. And then one fine day, when the IPO happens, so a lot of companies use this to misguide investors and circulate funds. So that is where SEBI usually kicks in and provides restrictions and regulations while going for pre-IPO allotments. So that is where the ICDR regulations kick in for even unlisted companies. Yeah, so we have come to the end of the session. Just two very simple case studies. TechStart Private Limited, a DPIIT recognized startup. Okay, so they have a domestic VC fund who is willing to invest 5 crores via compulsorily convertible debentures. Conversion of the debentures will be at IPO or the next round. There is no foreign investor. We need to check following items. First of all, we are issuing a compulsorily convertible debenture. Better we go for the change in authorized capital now itself. So check the authorized capital. If you have to increase it, please increase by filing SH7. Then you have to pass a special resolution. If it is a private placement of the debenture, you have to pass a special resolution for it. And then obviously, if it is a private placement, go for PAS4. Allot the and then you also have to have the board meeting. Once you pass the special resolution, file MGT14 within 30 days. Once you have issued the PAS4 and you have gotten the application money, you have to open up a separate bank account. Do not touch it until allotment. Once you have allotted, transfer the money into your regular operating account. And you have to also file PAS3 after the allotment is made. So these are the basic steps by we have to do if for a given scenario like this. Next, Manufacture Co. Private Limited. It is in manufacturing. It does not need specific government approvals. They have the option to get they have the approvals under the automatic route. A US company wants 25% equity stake for $2 million. Existing promoters hold 100% stake. It is not a recognized startup. So now, because there is a foreign investor involved, we need to be careful about FEMA related regulations. Under the Companies Act, again same thing, check authorized capital. If you need to increase it. Board approval is required, special resolution is required. Because you are issuing shares, you also need the valuer's report. MGT14 has to be filed after the special resolution. Allotment has to be made. And once you have allotted, PAS3 has to be filed within 15 days. And before the allotment, if you are receiving the money, you have to park it in a separate bank account. And then after you have filed the PAS3, update your register of members. This is with respect to Companies Act. Now you go into FEMA. First, you need to be very sure that this is in the automatic route and you don't need a government approval. Prior approval is not required. Second, investor KYC is very, 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 very critical.
KYC has to be pointer. Sometimes they issue only 4 pointer in KYC. So it has to be from the bank of the investor.
Correct, correct.
So it has to be a 6 pointer in KYC.
Yeah, correct, correct. Correct. Yes, KYC is a very, very practical issue that people face. There is actually one startup which I know of where they had a foreign investment, but they had an issue in the KYC. The investment has come in, but I think now they will be battling out and settling the matter. Yeah, they have to refund the money back. Yes, the banker himself will send it back. Yes. Say again, open an escrow account. Anyhow, you have done a valuation for the Companies Act purpose. You can continue to take that for the FEMA also. But I mean, if you choose to do a FEMA pricing again, you can get another valuation report either from a merchant banker or a chartered accountant. Get the funds, file FCGPR, and one thing which you also have to file when you get foreign investment is a FLA form, which has to be filed every July 15th. So you need to file a statement of assets and liabilities. So that is all. So just in brief, whatever we have covered: capital raising, you have multiple regulatory compliances involved. You have, and all of that will act simultaneously. You cannot say you will pay attention to one and leave the other for another day. First, decide what you want to do with the money, what you want despite you getting the money, what you still want to do. If you want to retain control, do you want to be tax efficient, do you want to preserve investor wealth, what do you want to do? Be very clear and then choose the right form of instrument. Then decide what is the form of issuing the instrument. Should it be a private placement? Should it be a preferential allotment? Be very careful. Take care of the relevant procedures. And income tax, as I said earlier, though the new law has come into force, we will still have to be dealing with the old law for some more time until the transition period has been completed. With that, I have completed my presentation. My phone number and email ID is available here. You can always reach out to me whenever you need to, in case you have any clarifications. I am open to questions if you have any. Now is lunch break? Oh, okay. So I am well ahead of time. Oh, okay. Great. So, okay. Thank you so much. Thank you, everyone. Thanks for your patient listening. Hope it was a knowledge gaining session. Thank you.
Thank you, sir. One key takeaway from this session is that successful capital raising is not merely about funding. It is about choosing right structure and ensuring regulatory compliance at every stage. Your step-by-step approach in each process has been extremely valuable. On behalf of SIRC and all participants, I extend our sincere gratitude to you, sir. Let us give him a big round of applause. Their refreshing lunch. So now I'll call upon the dice, Balaji sir and Shyamala ma'am on the dice, please. Now I would like to call CA Mahir sir on the dice to present the memento. We now move to session 3, and it's my privilege to introduce our distinguished speaker. First, we have CA Balaji, a director at PW & Co. LLP, Chennai. Balaji sir brings with him over 13 years of rich experience in transfer pricing, planning, risk mitigation, documentation advisory, advanced pricing agreements, and global compliance support. He has worked extensively with multinational clients across diverse industries, including automobile, digital payments, healthcare, technology, and infrastructure. He has successfully concluded bilateral APAs for leading global companies and has contributed widely to tax journal and forums on the topics such as digital economy taxation, intra-group service, and OECD Pillar 1 and 2 initiatives. Balaji sir is also a regular speaker at ICI, CFO Forums, and International Tax Association. Joining him is CA Shyamala, manager at PW and affiliates, Chennai. She has 5 years of expertise in transfer pricing compliances, litigation, advisory, and planning. She has been actively involved in mutual agreement procedures, policy setting, and evaluation implication of Pillar 2 initiative. A commerce graduate from University of Madras and a member of ICI, she brings sharp insight and practice perspective to today's section. Please join me in welcoming sir and ma'am. Thank you.
Good afternoon, everyone. Very conscious this is a post-lunch session. So the way we have designed the program also is to add more controversies and any open items which I'm sure the audience before us will also be able to resonate. And the idea is to share knowledge, and we are very open to make it more collaborative and interactive as possible. So I request you to all raise questions so that it's both ways. First and foremost, between me and my co-presenter Shyamala, we thank SIRC for this opportunity for us to conduct this session and share our knowledge. So with this, very quickly getting to the topic which is on hand. So we thought in the past 2 years, there has been significant noise around related party transaction governance, right? It is creating quite a bit of interest amongst professionals and also corporate bodies and various other regulators, including independent directors. So our intention here is to try and dissect the law as the provisions exist, and to also practically share some insights on how this is actually getting addressed in audit committee discussions and boardroom discussions, and what we as professionals should be aware of as we go along and help clients. So this is the broad background. And of course, I'm conscious in the past 2 days, we also got the very recent ECB final regulation, which has actually been, I would say, very investor friendly, and hence we thought we'd also share some key specific positive aspects from that regulation as well. So again, very moving on. So yeah, as you can see in the slide, it's a very important slide. The related party and related party transaction definitions are very different in each law. Companies Act defines something. SEBI LODR is very different. Ind AS, of course, is very wide, and very recent income tax amendment on the definition of related party has also been amended significantly, bringing in larger entities into the ambit. So idea here is to try and understand what they are as of now and how we can help companies harmonize compliances. So if you see in here, LODR talks about 2 specific aspects. The intention of LODR is protection of minority interest, and more importantly, to ensure there is governance in place as far as transactions are concerned. The larger interest being the transactions with promoter-driven companies. So there is significant allegations that there are mischief happening. So that's the larger framework. And the past 2 years, there has been significant effort, not just by SEBI's working group, but also industry bodies like FICCI, CA, etc., who have been helping SEBI develop this, what we call as a minimum industry standards, which establish what is a level of documentation which need to be compiled by the company to demonstrate transactions are in the best interest of the company. It's in the ordinary course. So net, the responsibility of the audit committee of a listed company is not just about listed company transactions. It is also to cover the reasonableness of the RPTs of the respective subsidiaries of the listed company. So from a coverage standpoint, this is much larger and bigger, and that will be important, and this is regardless of whether the transaction is with a domestic company or not. So we may not necessarily see a tax angle, but this is larger from a governance standpoint. Of course, Companies Act has a much, I would say, a narrower definition of related party transaction itself, but then it also has a very similar flavor on whether the transaction is in the best interest of the company. We will deal with this in detail. Just slightly moving on, Ind AS 24. Before I jump to Ind AS, as you all can recollect, our accounting standards, which is otherwise India GAAP, talks about a situation where if any company can exercise control or influence on another company, it qualifies as a related party. That was a very, very broad overarching definition, and the term control was never defined at all. And SEBI kind of addressed this view by bringing in these new regulations in a way, because otherwise each company took a view that they are not controlled and stuff. Of course, Ind AS has a much more, I would say, a larger definition, but still, as far as the definition of promoter group is concerned, they were not very accurate in terms of defining the control aspect, which is again covered as part of the recent SEBI LODR regulation. So, in summary, in a nutshell, what we want to convey is LODR actually takes care of these inconsistencies in definitions, and it has a much more tightened definition as far as both related party and related party transactions are concerned. For now, I am keeping the income tax related party discussion out because we want to focus on the Companies Act and LODR for now. The larger point here is, while Companies Act mostly takes care of internal documentation, LODR has a larger public perception angle to it, because listed companies are supposed to report all the related party transactions twice in a year. It's a one big blown, very detailed, data intensive form which is out there in public, and we see lot of representations or critical views from research analysts and also the company's stakeholders, etc., trying to defend or possibly have a different view about the nature of the transaction. So I would say, from a outreach and sensitivity perspective, it's important that we as professionals are aware of the LODR regulations. Very quickly, I will probably pick up a couple of points here. I discussed the other aspects later. So if you are aware, the income tax regulation also had very specific provisions on domestic related party transactions. So it is about a situation where you have a transaction with a company which is a related party. You had our earlier section 40A2, which was one position. The other position was a transaction you have with entities who are eligible for a concessional tax rate. So 48 of course has got amended. The other one exists. So the reason I'm trying to say this is, from an income tax standpoint, there is much lesser focus on domestic transactions. But that said, Companies Act has a much more larger weightage and coverage in that sense. So what are the 2 or 3 important sections? Section 188, 177, and of course 2 subsection 76. 2 subsection 76 covers the related party transaction definition, which is a very typical definition. Anything above and below essentially is covered. The larger point here is, in 188 there are specific exemptions for private companies. So the other aspect is, the section itself covers only a certain, I would say, more narrower set of transactions. Let me read it out for your understanding. Sale, purchase or supply of goods or materials, selling or buying, disposing of property, availing, rendering of services directly or through agents, appointment of related parties in the office or place of profit, underwriting or subscription of shares. So if you read this, you will realize that these are more to do with routine customized transactions. It doesn't deal with transactions like issue of shares, a corporate guarantee, etc., which frankly are a high risk transaction from that perspective, which is not typically covered in a Companies Act, but it is covered in LODR. So the reason here again we want to capture this is, manner in which 188 and 177 are designed are very different. So 177, as you know, deals with audit committee approvals from a Companies Act perspective. Of course, there are very specific conditions on paid up capital of 10 crore, turnover of 100 crore, and aggregate loans exceeding 50 crore. These are the very typical conditions when a company will require an audit committee. It doesn't mean these are mandatory conditions. Companies voluntarily can also have an audit committee. that is also provided for. But net, this goes to show that the coverage is more for material companies. From that perspective, smaller private companies are exempt. The larger point here is, while 188 may not cover certain transactions, the manner in which 177 is worded is all RPTs will need to be approved by audit committee is the language. So in a way, it clearly goes to show that the ambit of transactions before an audit committee approval is much larger than 188. So while someone can typically argue corporate guarantee is not covered in 188, it doesn't mean that it is not supposed to be approved by audit committee. These are two different things. And this is again very specifically called out in our own guidance note and also the guidance note issued by Institute of Company Secretary. So this goes to show that we need to maybe look at both of these aspects from different lenses. Again, I'm trying to list out all potential FAQs which possibly can come to your mind. Whether these provisions are applicable for foreign companies, limited answer, yes, it's a group company. Intangible transactions, are they covered or not, etc. Again, two different views. One is, as long as you are selling or purchasing, then it gets captured in 188, otherwise it doesn't. So there are also aspects like, do you need a prior approval of the audit committee as per 177? Again, the language is not clear, but it goes to show that this the larger point is about an approval, not a ratification. So harmoniously interpreting, approval means it has to be a prior approval is something which generally all academic bodies align on. So even very similar to a SEBI LODR, even 177 of Companies Act by and large requires a prior approval of transactions. It's not like you can ratify, is the view. And of course, there is another anomaly here. It might so happen that an audit committee may not be comfortable with certain related party transactions. It can clearly say, I will not give you an approval. But 177 enables audit committee to refer positions and also its objections to the board, and board can possibly even approve those transactions, is what 177 reads. So practically I have not seen a case, because most of the companies are covered as part of listed entities regulations. Their very logical flow is, board will have to put up a case, the business rationale or the business case, etc. Audit committee sees it, approves or rejects it. But 177 to that extent is slightly differently worded. So I just thought I will share this anomaly here. Again, two important pillars in 188 is, a company need not actually require 188 if it passes two tests. One, if it's in the ordinary course of business. Two, if it's at arm's length. So when it comes to ordinary course of business, again, not defined. We can at best go to standards of auditing and gather some inferences on what could be a not ordinary course of business. Any circumstantial transaction which doesn't have a real source of income, and essentially transactions which are circular in nature, transactions where contracts have already expired, with significant discounts which does not align with the potential third party behavior. So potential restructuring transactions which you don't do on a daily basis. These are something which you can possibly say these are not in the ordinary course. That's an indirect way of inferring. But practically, based on whatever positions which can be adopted in various decisions, we have come up with a list. This is a 12-item list. It can of course be more. These are scenarios where companies will be better positioned to explain that some of these transactions are the ordinary course. So the financial scale of an activity, again, the kind of related party transaction, purchase or sales, whatever it is it in line with the transactions which a peer company could make? Is the volume of transaction commensurate with the, say, revenue on the profit base of that company? These are very important indicators. Of course, there could be other aspects like, if the intention of the transaction is to specifically further the business interest of the company, which is what we look at as a commercial expediency. So these are very typical business scenarios where companies will be able to defend that few transactions are in the ordinary course. Anything which is apart from this, which is non-routine, will certainly have to be taken up for approval. Now, a very quick snapshot. Here we have just summarized what could be a potential implication. So net, the inference from this slide is, if it actually passes both tests, which is ordinary course and arm's length, no approval. If it does not pass one of them, it has to go through another one level of approval. and of course both need to be appraised. Most importantly, there is also a condition on material RPTs even within Companies Act, which will require a shareholder approval. As we all of us know, for us to put up a transaction for a shareholder approval, it needs significant amount of information and guidances as well. So very transaction specific thresholds have been defined. It is again very unique to each category of transaction which has been presented on the slide. But the larger intention is how do companies even monitor these two tests. So I would say from an ordinary course perspective, it is only left to the management of a company to define and defend the nature. As consultants, we may possibly have lesser role in that, but that said, we will be able to certainly add lot of value on the other condition, which is what we call as the arm's length testing approach, where there are very defined principles in the Income Tax Act and even otherwise which has been defined in the guidance notes, where of course there has been significant judicial precedences on each of the class of transactions on the potential implications if transactions are not in arm's length. So these specific scenarios help us add a lot of value to clients and corporates. It's a very quick comparison of what are the provisions itemized wise between Companies Act and LODR. We intended this to be a more introduction to our next larger topic on LODR. If you can see broader definitions incorporating accounting standards and SEBI specific relationship, which is the promoter aspect. Of course, much larger, wider definition of related party transaction itself. It talks about resources, services, obligations. Either of them need not be necessarily in return. Even a constructive arrangement will lead to a transaction. So as you can see, LODR can cover any potential transaction under the sun because of the kind of nature it has been defined with. Of course, audit committee approval is a prior approval. There are very specific documentations required, unlike a Companies Act. As far as LODR is concerned, the materiality thresholds have also been very significantly, I would say, revamped in December 25, again based on significant industry representations. It has been undergoing multiple changes in the past 1.5 years, but the final landing is very aligned to the volume of a business, unlike the earlier thresholds which are very fixed in number and etc. So that relaxes a bit of a compliance, unnecessary compliance burden, I would say. But the larger point remains that the focus on LODR is not just about the listed companies' transactions alone, it's also on the subsidiaries. Of course, the periodic monitoring, stock exchanges, we have certainly seen cases where stock exchanges come up with very important observations qualitatively and also quantitatively. Say for example, two listed companies transact amongst each other, and both of them are supposed to report this to the SEBI twice in a year. Their purchases has to be the contra value in the other company's sales. It might so happen there could have been reconciliation issues. We have seen SEBI look at this very, very particularly because SEBI has come up with a tool which analyzes the data of various companies, cluster wise, transaction category wise, revenue, profit wise. So they have lot of matrices and ratios through which they are able to derive very meaningful data insights and inferences. So one of the specific observation is about even value reconciliation. So the depth at which regulators are looking at this is going to be much more higher in the coming years, I would say. So before I hand this over to my colleague Shyamala, very quickly setting a context, you would have seen a lot of investigation reports out there in public domain, and I don't want to name companies, but net, the larger theme which comes out of all of these observations is, I would say, put it in three baskets. One is absence of discipline in identifying related party, unrelated party transactions and reporting, that is one. Two, not able to explain the arm's length nature of the transactions. And three, and most importantly, the approvals. A company is expected to get a prior approval of all the related party transactions. There have been instances where the approval limits have been breached in quite a few cases, and SEBI has taken note of it and raised penalty implications on those companies who have breached the approved thresholds. So the larger intention is to have a very methodical process, of course both people and process, amongst various departments, not just tax or secretarial but also finance and accounts, because as you can see, there has to be a process to even define a related party, and the related party keeps changing because of the multiple nuances which are involved in the definitions and stuff, and of course the control on the related party transaction reporting and the ultimate justification. So with this, I would possibly hand it over to Shyamala, who is my colleague, to explain us the nuances of some of these regulations.
Thank you, sir. Good afternoon, all. So, as sir had given a very broad overview of how Companies Act and has increased the rigor of related party transactions, we'll just dive into what was the reason this SEBI LODR came up with this new minimum industry standard. So, before I go into that, just to expand on what sir has already explained about the related party transactions, we'll just see what are the new definition of the related parties. So, as sir had also already spoken about, Section 276 of the Companies Act gives this broad definition of who are all the related parties. And what happened was, in SEBI earlier, it was just a simple definition that any related party who is defined under the Companies Act or as per the applicable accounting standards. Then what happened? In 2022, this amendment came which told that any related party or also a promoter or promoter group of the related party. So, which means that if any person or entity holds more than, is a promoter or a promoter group, or also holds more than 20% of more of the equity shares, then at any time during the previous year, then they also fall under the purview of the related parties. What happened? This 20% then later on became to 10%. So any entity essentially where the promoter or the promoter groups is the main holder, or where it holds more than 10% of the 10% or more of the equity shares, then they are considered to be related parties. Moving on to related party transaction, this Companies Act, again, sir had already shown what 188 mentions about a sale, purchase, all these things that are listed on the left. If we go to the right, what happened again in LODR, earlier it was just mentioned any transaction of the listed entity with its related party, that's it. In 2019, later on in 2022, an amendment came to tell all the transactions, transfer of resources, services or obligations between listed party or its subsidiary on one hand and its related party or its subsidiary on another hand, also to bring in the purview. Just to explain this, I will just show this here. So earlier, ABC Limited was a listed entity and any transaction of ABC with its related party was already covered under the erstwhile LODR regulations. Later on, from 2022, ABC transactions from ABC to subsidiaries of ABC is also covered now. That is the dotted line that we see. This is the first amendment. Then from 2023, the second point that we see here, all the transactions, transfer of resources, services or obligations between the listed entity or any of its subsidiaries, ultimately that the purpose and effect of which is to give a benefit to a promoter or a promoter group, is also covered here. So this just to illustrate how this is given, in the working group report, this is how it is actually shown. As per the erstwhile provisions, if A is the listed entity and B and C are its subsidiaries, all the transactions from A to B and A to C are covered. Similarly, A1 and A2 are related parties of A, so they are also covered. Whereas the transactions of A to B1 or A to B2 are not covered. After this amendment, what has happened is, all this is how it is like a web. Any transaction that is between the related party or its subsidiary to any of its related parties is also covered subsequently. So that is the diagram that we see in the right side. So ABC, subsidiaries of ABC with any other related parties also subsequently fall under the ambit of SEBI LODR. Now we move on to industry standards. So just I had mentioned earlier, I had given a passing reference of the term working group report. So what had happened in 2017, a Kotak committee was formed wherein SEBI had felt that decisions are taken without giving due importance to the minority shareholders, and therefore to protect the minority shareholders and also to deal away with structures where lot of profits are being shifted between the group entities, SEBI had formed a working group report. The working committee. The working committee gave a working group report in 2020. In that, what happened? They had told against each of the regulations, Regulation 23 Z, A, B, C, all those things, what are the changes that are to be made? This is because whenever the minority shareholders are not given due importance, it was felt at a larger point in time that there have been instances where lot of funds have been shifted from between the group companies. So to protect this and to make it more rationalized and legalized, to ensure more compliance on the companies from a listed entity perspective, this RBT industry standards were affected. This happened in February 2025 with effect from April 1, 2025. Then a circular came in March 21 where the effect of related party RPT industry standards was proposed to be moved to July 1, 2025. Again, before the standards could come into place, a new circular was issued in June 2026 where the reporting obligations itself were totally revamped and they were proposed to take effect from 1st September 2025. So here if we see, this gives a matrix of what are the RPDs that are covered, essentially what are the things that are to be required under the minimum industry standards and where the audit committee approval is required. So for example, if a transaction has already been approved before the introduction of the minimum industry standards, then they need not come and present all the additional information that are required. Whereas if it is not there and only after September the transactions have been entered into, then they will have to comply with the additional requirements that are there. So moving on, just to give a brief overview of when audit committee approval is required, for all the related party transactions, audit committee approval is required. Now, the erstwhile, as we saw earlier, erstwhile disclosure requirements was very broad. It didn't give anything specific. Now, the related party minimum industry standards mention 3 parts: Part A, Part B, and Part C. So, Part A tell about the basic details that have to be given, like name of the related party, period in which the transaction incurred, where is the company incorporated, all those things. And Part B and Part C are applicable only for 7 types of transactions. So if any of the transaction is under that nature, then they have to give. So Part B, and what is the difference between Part B and Part C is that Part C applies only if the related party transaction is material in nature, and Part B is for all the other transactions that come. Now, when do these standards not apply is when it is between a listed entity and its wholly owned subsidiary, or when the total value of the transactions are less than 1 crore, then it does not apply. Or even between 2 wholly owned subsidiaries where the ultimate consolidation happens at the listed entity level, then there also these industry standards are not required. Later on in October 2025, a relaxation was given. A relaxation was given that if the total value of the transactions does not exceed 10 crores or 10% of the annual consolidated turnover, then only basic details as shown in Part A can be given and the others need not be given. So this we saw about the audit committee approval. For the shareholder approval, these 7 mandates were given in the June 2025 circular. One of the earlier requirements under the June circular was to give a QR code for a valuation report or anything that was relied upon to certify a related party transaction. But then later on in October 2025, it was taken away. Now moving on to prior approval. So what happened to the materiality thresholds, as sir had also indicated, was earlier it was 1000 crores or 10% of the annual consolidated turnover. This was now later on changed to a scale based, where now if a transaction is considered to be material, only if the turnover exceeds 20,000 crores, then it is scale based to say 10% of the turnover. And similarly, if it is between 20,000 to 40,000, then. So this is how it follows. Now just to give a small example here. So if the annual consolidated turnover is more than 10,000 crores, which for more than 10,000 crores, and the turnover slab is okay. First, let's keep it as 10,000 crores. Then it does not apply. But first, if it is like say 21,000 crores, then up to 20,000 it will be 10% of the turnover, and on the extra 10,000 it will be from the next slab. So which is 2,000 crores plus 5% of the turnover. So we will take only the 5% of the turnover that is above 20,000 crores. So this is for the material RPTs. Now moving on to RPTs of subsidiary, an audit committee approval is required. Earlier the provisions was that if the value exceeds 1 crore or 10% of the consolidated turnover, which was later on changed to standalone turnover of the entity. Now the audit committee approval is required if the RPT value exceeds 1 crore or 10% of the subsidiaries turnover or listed entities material RPT. So this is where there is a grey area on why the listed entities material RPT has to be taken instead of the subsidiaries RPT. This is mainly to harmonize the threshold along with subsequently one more came where HVDLEs were also proposed to adopt the same scale-based turnover threshold. So there is also one harmonizing aspect there. Then if the subsidiary doesn't have a financial statements, then it's the same, but just that the difference is that it has to be taken as 10% of the paid up share capital or securities premium, and the listed entities, again the listed entities RPT threshold. Now if the omnibus approval intermittently an amendment had come wherein earlier omnibus approval was considered to be effective only for 1 year, and now also it continues, but the only amendment was that up to the date of AGM also, even if it exceeds the date of AGM, it was still considered to be valid. Now at every AGM it has to be revised. The approval has to be sought freshly. These materiality thresholds are for transactions other than royalty, whereas if it is a brand royalty, then the threshold has to be like 5% of the consolidated turnover. So this we already covered. So one more thing is this concept of what are the transactions that we have to cover, whether they have to be seen party wise or transaction wise. So it has been clarified in one of the cases that the thresholds have to be considered transaction wise even if it is with multiple parties and not party wise. Material modification, again it is left to the discretion of the audit committee to frame a policy, and there it is based on the policy, RPT policy that has been formulated, material modifications we can adopt. So just to delve into the details of audit committee approval, the minimum industry standards that we had seen earlier. So part A requires these. So one is the basic details such as name, country, amount of the proposed transactions and all those things. Now let's move to part B. So part B first is this sale or purchase of goods. So here it requires the bidding process, the price determination method and trade advance details. Now bidding process, what are the generally that are required when we see the related party disclosure, what are generally requested by the audit committee is that whether it was open limited or a limited tender, or what was the basis for selecting the related party, how does it compare with the market prices, what was the basis of determination, is there any listed, is there any published price list from which we can see. So these are all some of the basis on which the audit committee generally relies upon for selection of the related party as the person for this transaction. And the price determination method, again, now one point here is that why do we come to the Income Tax Act for determination of arm's length prices? That okay, anywhere it doesn't, SEBI also it doesn't mention clearly what is the method to be followed for determination of the arm's length price. It just mentions that the transactions have to be at arm's length. So since there is no other reference anywhere, we come and we rely on the Income Tax Act for that. So Income Tax Act, as per the Income Tax Act, if we were to take, there are only 6 methods that are there. So one is the comparable uncontrolled price, then the resale price method, cost plus method, profit split, transactional net margin method and other method. Generally for purchase transactions, a comparable uncontrolled price would be preferred if the market data is available. But this is again just a general guidance. This is what we have seen in presentations made to the audit committee. So part C doesn't have anything specifically for sale or related party. It's just a sale or purchase of goods and trade advances. Next, moving on to loans. So loans here, again, one relaxation that has come is that earlier the credit rating was required to be provided in part B itself, whereas now it is sufficient only if the transaction is material, and then we can provide the credit rating. So these are the list of information that are required. One is source of funds, indebtedness, borrowing cost, interest rates, maturity, security purpose, etc. Now, if what to do if the interest rates are less than the rates that are generally prevailing or that is there in an intercorporate that we get from a bank code. So then we have to tell that what is the specifically reason why this lower rate was approved and what were the material differences that were considered. So one more thing is this past defaults that are required. Again, if it's a material transaction, then we have to give credit rating, past defaults, and also any other qualification, IBC status. Just to give a case law here, what happened in one of the cases earlier was in Gensol, I think the SEBI's finding had also come out. So ultimately, the promoters had floated a company, EV company, and they were procuring some materials for manufacturing of such EVs. The funds were also IRDC approved and they had got the funds, but they had defaulted in the payments. They had also not responded to the summons that were issued by the court. Later on, when SEBI investigated, it was found that the funds were ultimately used for purchase of some personal property of the promoters' relatives. So that is the reason why these are requested now to be given. Moving on to investments, again, similarly, that is why the basic reason why they keep asking the source of funds is that whether it is based on borrowings. That is one more point. Whether it is already based on borrowing cost or whether it is from our cash reserves. So that is another point also that we have to see. Moving on to guarantees. The rational, binding, material covenants, recovery mechanism, value of obligation, accounting provisions. So here one deviation that we generally see from Income Tax Act is that there has always been dispute around whether a letter of credit is considered to be a guarantee, and courts, we have also fought that it should not be considered as a it should not be considered as a guarantee. But now it has been abundantly clear, and in the case of listed entity, that they are also covering comfort letters also, letter of credit also, as part of guarantee. But however, they have not included implicit guarantee, they have not specifically covered, but letter of credit or comfort letters, if it is specifically shown that it is only for the purpose of this listed entity, for the benefit of the listed entity or any of its promoter or promoter group, then they have to give the details. Similarly for borrowings, so these are, I'm just not going into line by line because they are just procedural in nature. Moving on to sale, lease, disposal and royalty payments. So now royalty payments was one area that we watched out for because they had asked for a peer analysis. If we see in part C, the last but one point, minimum 3 suitable and relevant industry peers. Earlier they had given actually a process by which it had to be, the peer analysis had to be conducted, but later on in the October revision they had removed it. So all these, why they are asking is the purpose of payment, the category of payout, whether to first of all check whether a royalty is required, is there actual use of technology or brand that requires a payment, such a huge payment for royalty. And also there were alarming trends that were found in one of the SEBI's working group report, again in November 2024, which showed that lot of payments were made by way of royalty by a listed entity or its subsidiaries, and this resulted in heavy losses for the entities. So this is how. So almost 25% of the royalties were exceeding 20% of the net profits. So all of this again boil down to the point that SEBI has a very strict vigilance mechanism now to keep monitoring the payments, intercompany payments. It may not be necessarily that they have to be within the domestic entity. It can also be cross-border also. So it is ideal if we keep an open eye and ensure that all these compliances are adhered to. So, over to you, sir.
So, thanks, Shyamala. So, I will probably add a couple of practical observations. So, Shyamala, of course, explained us about the fact that the purpose and effect of transactions need to be looked at. So, any transaction as a third party can also be recharacterized as a related party transaction. Now, this is a very interesting point. They have positioned this as a cumulative condition, the purpose and the effect. So, naturally, by consequence, if a benefit were to flow to related party, the intention is not to track those transactions. There has to be a very clear trail of events which is part of the arrangement where the benefit is clearly flowing to a related party. So, that particular aspect need to be brought out on facts, and it might so happen, say for example, a loan is actually given to a related party, but the interest which has to be charged to the related party is not as per market trends. But in a way, the pricing which is to a vendor who ultimately supplies to the related party is again misaligned. So this is one way where the flow of profits or cash can pass on. So this is one example. So they have talked about a cumulative condition. The second aspect is also the fact that from a pricing analysis standpoint, historically the trend has been to look at only the profits which my counter entity makes. Say for example, I purchase from a particular company, we are looking at the margins of the company to see whether it is in line or not. But these days, the focus is not just on the margin, but also the underlying business arrangement, the credit period, the terms, working capital cycle, discounting pattern. So, stakeholders, not just listed companies, but also by and large, even in income tax assessments and stuff and etc., the focus is more on the larger arrangement, not just on the pricing patterns as well. Of course, the one other point is on material modification. Possibly I'll spend few minutes on material modification. So the term has not been defined, but what we have seen in practice is, say for example, approval has been say granted for say 100 crores. If the transaction value exceeds by say 5%, that is naturally agreed by the audit committee also that this is a tolerable threshold. 2, if the underlying business character itself is changing, say for example the discount pattern changes, it does not qualify as a material modification. It has to again go for a shareholder approval or rather audit committee, and if it's material then it has to go for shareholder approval. And of course credit period changes, if the business itself actually gets say restructured or if there's a novation of contract, these are ideally looked at as material modifications, and each audit committee has their own practice of defining that aspect. Shyamala did speak about the guarantee piece, which is a very interesting aspect. We have seen the 1% reference point in GST as well, but it also happens that courts have also looked at the business background in which these guarantees are given, etc., and they are open to very different models. But the larger point is, in a comfort letter, certainly there is no commercial obligation on the person. It is essentially the fact that the lender needs to keep the subsidiary in good financial strength to meet the obligation. So there, I would say this is an open area. While SEBI may possibly have accommodated this as part of the disclosure requirement, companies do take a very technical view on how they want to present the nature of the transactions. Of course, one larger point is, while the regulations are applicable only for listed companies, we have seen other stakeholders draw a lot of teeth and power from these regulations for their other assessments as well. So even in our normal assessment proceedings, there are quite a few questions. Say for example, peer group, which Shyamala also tried to explain, where SEBI of course had a very different approach. It has been mellowed down. But these questions come up even in our normal assessment proceedings. So I would say there is a significant amount of learning, cross-learning as well among stakeholders. So, very quick summary. I mentioned it the start of the session as well on what it means to us, right, from a company and a consultant perspective. A clear need for a mechanism to track RPs and RPTs, process to trigger approvals and etc. And more importantly, to review contracts and also the working papers which support the basis of RPTs. So, like I mentioned, the transparency levels have significantly expanded, and this leads to significant penalties, which is something which I have captured as part of the material as well. So, not just qualitative, but also prosecution in very specific cases. Now, with this, let me quickly move on to the very interesting changes in the ECB space. So, let me focus on the changes that becomes easier. So, companies are allowed, rather LLPs have essentially been allowed to receive FDIs, which has not been the case earlier. And more importantly, of course, it continues that individuals cannot. But the expansion of the recognized lenders allows even non-resident individuals to act as lenders even without requiring the equity participation, which is again very good, I would say, a change in that sense. Of course, from a borrowing cost standpoint, they've removed the all-in cost ceiling, and what it means is they have defined this as a market-linked rate, which is I would say aligned to the international standards, which again in a way reflects the arm's length nature, that the overnight rates in most of the currencies are very significantly fluctuating. Say SOFR, say Sonia rates, and quite a few other currencies, it changes very drastically because of the overall the euro crisis, recession, and also the gloomy geopolitical crisis which has been developed. So because of this, there is significant inflationary pressures as well. So having an all-in cost will not make any sense. It has to be linked to the current market trend. And it is a good development. They are trying to realize this and connecting this to the overnight rates, which also will help companies have a transfer pricing certainty as well, since it's going to be more systematic. And of course, they've kept the minimum average maturity period consistent at 3 years for all type of borrowers, which is again explicitly being clarified. When it comes to, I would say, on lending, the intention has been very different in various structures, but net on lending continues to be prohibited as far as this regime is concerned. So, I would possibly want to conclude this overall session by having two key messages. One is about the fact that as far as transactions are concerned, the entire world runs on intercompany trade. So clearly, there is no business without transaction. 80% of the world is depending on transactions. So the more stronger and the better the business rationale, which has been placed before any authority, not just before the audit committee, but also before any stakeholders, will help companies comply with these regulations. Otherwise, we have seen cases where share prices dip significantly because of this. We have seen few decisions. Suzlon is an example. Rajesh Export is a very recent example where there has been significant allegation. Of course, Shyamala mentioned about Zensar. So, even a perceived risk can lead to potential, say, slash in business opportunities. So, it's, I would say, a compliance which is for business survival rather than just a procedural compliance. So, from that perspective, I thank the audience for a patient listening. And if there are any questions, very specific, happy to take it, sir. Please.
Five types of
So, again, sir, yeah.
15 lakh, 11,000 crores.
Sir, what I can do is, sir, I think this slide can help us. Oh, yeah. 2-3 things I will say, because the question you raised is very pertinent. And I would want to use this slide to explain this better. So, net, the volume of RPTs needs to be commensurate with the scale of my business to start with. And there are genuine cases where my sales and purchases could be related parties. It is completely fine. But it has to be backed with a commercial, rational experience. If it can't be just a pass-through. The reason that there is a very specific amendment on even third-party transaction purchase per person effect is to track this very specific aspect. One is about movement of cash to related party or the promoter group. That is one piece. But the larger aspect is also financial irregularity. It is more on accounting as well, I would say. So that's why I mentioned that it's a shared risk among, say, finance, tax, and secretarial teams. Of course, external stakeholders as auditors, and we are responsible for it. So some of this can be easily tracked by having these processes in place. Even from a risk and impact perspective, we have started seeing start auditors qualifying RPT specific aspects much more in detail in the past 6 months. Because it is very clear that an absence of a process can lead to these irregularities. These are only sample testings. There could be much more if SEBI were to, and there is currently a pilot project, where SEBI has come up with an MOU with an MCA to undertake a data analytics framework. And clearly based on the numbers, the level volume of RPT with the revenue, profits, and etc. within the peer group, within the industry cluster, the category of transactions being same or different, there could be much more insights which come up in investigation reports as well. So I would say the stakeholders are also very keen on analyzing 2-3 points. One is inherently is it aligned with the business standards. Two is impact of geopolitical crisis. We have started hearing in board meetings as well on how trade war, or for the matter even Iran war, impacts. And if someone says export margin is significantly higher, the stakeholder is very smart to pick up that, boss, it is not because of the business performance, it is only because of forex fluctuation. You tell me what is the basis of your pricing. So stakeholders are much more well informed from that perspective, and they are seeking information and questions. And if companies are able to demonstrate documentation, Rajesh, export may not repeat. That's the larger point. But very specifically, intellectual property, royalty payments, interest transactions, interest-free loans given to group companies without substance. It is certainly a shareholder responsibility to keep funding the subsidiary, but with an intention to see how the subsidiary can make profits. It can come back to me as dividends, which is an accepted principle. But the cash cannot be moving to a loss-making company perennially. That doesn't lack any rational or commercial. And we have seen substance-related questions also coming in. Of course, stakeholders have become more smarter. This is a concept called country-by-country report, which is essentially a global P&L balance sheet. Everything in one place. Very specific business-related chart, which says how much revenue from related party, third party, what's the profit, what's the income tax you have paid, what's the income tax you have accrued, what is your stated capital, how many employees you have, how much of it is contract employees. So all of these bring to light the real background. And if it has a very good commercial substance, we have seen companies positively position this. For beginning in the annual reports to say, see, this is my, Vodafone was the first company which actually publicly disclosed their CBCR data. And they had a very country-specific nuance on why I am making loss in Africa. It is because of a third-party behavior, not because of a related party. The fact that there is economic crisis also impacting my business. It's not like I'm pushing the cash to related party. So, if there is people and process, companies can actually take this to their advantage of showing that how transparent and confident they are. If it's not, then it's going to get to cracks. PE and POEM are very typical implications we see, especially in outbound. But we also somewhere realize the fact that AI, which is another important factor which is coming up, is going to significantly revamp the virtual support which groups are currently providing. We might have reasons on productivity issues, even simple cost plus companies, impact of AI. There are questions on, do you need even so many people? Existential questions, because there is interplay of AI. And stakeholders sometimes even go beyond rationals to help companies, say, get to this kind of cost optimization efforts as well. Because they are connecting this back to say, if you need so much fund or a later party transaction which has to happen, a service payment you need to make, have you factored the AI impact? I don't want you to overpay a related party. So stakeholders have become more knowledgeable in that sense. Maybe in the next 6 months with these all, I should also mention the industry standards are actually now only getting tested from April 1 because it is effective April 1, that's it, because the budgets for past years sort of already got happened. So this is the first year where all of the regulations and documentation requirements which Shyamala explained will be put to real practice. And in there, it is in the independent director's best interest that he is going to ensure that there is sufficient compliance, because he is the only person who can approve RPTs. So in a way, I would say this is a positive paradigm shift in the space of RPT governance. and we hope we will see lesser investigation reports go forward. Oh, I hope it answers. Sorry, I made a bit longer, but if there are any other questions, happy to take. Sure. Thank you. Thank you so much for the patient listening. Thank you.
Thank you, sir and ma'am, for your insightful session. The practical perspective shared on relative party transaction and ECB regulations will certainly help all of us in our professional responsibility. On behalf of SIRC and all participants, I extend my heartfelt thanks for an excellent session. Thank you. As I conclude today's program, I would like to express my sincere gratitude to our distinguished speaker and generously sharing their expertise and experience. I thank to Chairman, Secretary, Managing Committee members, SIRT team, volunteers for organizing such an event, and thank you for this opportunity. I would just like to leave you with a simple thought. A value of profession is not measured by what they knew today, but by how committed they are to continuous learning. Thank you.